Okay, so very good morning to all of you, and I hope you guys are doing great. Today we would be starting with our fast track batch for financial reporting. This is your paper number 1, and undoubtedly among all the 8 papers or even 6 papers if you are going to opt into the new course, this is the widest among all, and that is why it has been placed strategically as paper 1. So you have enough time to study before your exam. You don't have to worry about shortlisting stuff to be done in 1 day, 1.5 days, 2 days. No, you'll have a good week before your exam, and hence the coverage over here is fairly exhaustive. So what are we going to cover in this batch? What are the important topics? A quick overview about financial reporting. Let's get started. Okay, so if you have any questions, queries, you can just put this on the chat box as well. So in terms of, okay, I'll just give a brief introduction about myself as well. Bhavik Chokshi over here. I've been teaching for close to the past decade, and I do teach financial reporting, strategic financial management and GFRS at financial level, and accounting and advanced accounting as CA Inter. In terms of my academic qualifications, I've completed my CA with a rank in my CA final, CS, and also a CFA from the US. I've also done diploma IFRS, and in terms of work experience, after qualifying, I've been working with Morgan Stanley in their investment banking team, followed by JM Financial in also their investment banking team. Parallelly, I used to love teaching from a very early age. From my early college days, I used to teach, and hence teaching was something which came naturally and eventually got the better of me, and thankfully I'm with you over here doing something that I love, and hopefully you will also love the subject that we are going to do. So apart from this, like everyone, I do love traveling, and we do a lot of backpack trips. Hopefully after your exam we will meet once and go for a trip once. And I also do a lot of swimming, and I'm a national level open water swimmer as well. So that's a quick introduction for myself. Now, something which you're more interested in about the course. So financial reporting is a fairly exhaustive subject. What do we cover in this subject? Well, if you see your index broadly, you will see Ind AS is kind of dispersed everywhere. You'll see Ind AS is spread across. It's a fairly detailed index, close to 30 topics, but almost 27 of them pertain to Ind AS. So your entire paper, at least 95 marks of your paper, is going to come from Ind AS. We are going to discuss what is an Ind AS, etc. But in terms of coverage, you will do from the absolute scratch, that is Ind AS 1, presentation of financial statements, up to something like Ind AS 115, 16, leases, revenue, financial instruments. So we'll do a wide array of standards covering everything into your accounting framework. So what is the level of importance? Now, because it is such a wide subject, you have certain patterns of topics which almost come in every exam, and certain topics which may or may not come in your main exam. So when we are looking at your FR paper in your financial reporting, if you want, you can note this down. This will be a fast track batch. So as a result, we will be covering everything in this batch. 900 plus questions covering everything from the study material, from your RTPs, MTPs, from your exams as recent as November 22. All the materials have been incorporated. You don't need to refer anything else. The coverage over here is exhaustive. And in terms of the batch, what I would recommend you to do daily is we would be covering all the conceptual provisions, which will be done from our FR Shield, and we will be doing sums. So I will be discussing sums. We will read each of the sums. I will discuss each of the adjustments, and where required, I will solve. However, the solutions will be given to you. So if there will be a separate book, I'll just open one of the volumes. Let's say this is volume number 3. So there will be a question, there will be a space for summary, and then there will be a solution. So you can refer these solutions. I would strongly recommend that you do that on kind of a daily basis to ensure that you are on speed. If you do that, trust me, over the course of this batch, you will be absolutely comfortable with financial reporting, whether you're doing it for the first time or whether you have done this and you are kind of strengthening your base. Irrespective, if you just follow that, if it's probably a 3-hour lecture, you spend an hour or so referring to the stuff that is done on a daily basis, you should be in a really good position by the end of this course. Yes? Okay. So we will kind of look at the overview. So when we look at financial reporting, one of the most important topics that is there in financial reporting is a topic called as financial instruments. This is covered under Ind AS 32, 109, 107. We loosely call this as financial instruments. So this is something which comes for financial instruments. This will be coming for anywhere between 15 to 20 marks. 15 marks, let us say 15 to 18 marks on an average. So that's a fairly detailed coverage. You will have at least 2 questions, sometimes even 3 small questions on this topic. I would believe this is the heart of your Ind AS, the chapter on financial instruments on your index. This is on point number 27. This is something which is very important, will come from anywhere between 15 to 18 marks on your main exam. This is top of tier 1 in terms of importance. Next, you have business combination and consolidation. I mean, you can view them as 2 different topics, or we can view this as a single group of topics, group financial statements. So we will cover 3 topics over here. You can treat them separately as well. The topic on business combination, which is similar to the topic of amalgamation in a way that you might have done AS 14 in your inter-CA. The topic of consolidation, which is similar to AS 21 that you might have done in your inter-CA. And then there is a topic on joint arrangements and associates, which is something that you have not done, but together we can call these as group financial statements related topics. Now, a lot of times people give separate weightage for business combination and consolidation. I've just kind of clubbed them, and hence this is also totaling to around 20 to 30 marks overall, depending. Sometimes you get a question on only consolidation, like in the last exam, November 22, question 1, sub question A, a good 15 or 16 mark question only on consolidation, and then separate questions for associates, separate questions from joint ventures, separate questions for business combination. Together, we would expect 20 to 30 marks together for the group of these chapters, not just for a single chapter. Maybe business combination around 8 to 10 marks, consolidation around 15 odd marks, and maybe joint arrangements around 4 odd marks. So together 28, 29 and 30. This is group financial statements where you expect at least 20 to 30 mark weightage to come in your main exams. 20 is bare minimum, sometimes going all the way up to 30. So these 3 topics over here would be again a 20 to 30 mark weightage. Next, you will go to share-based payments. Now this is similar to what you have done in ESOP. Remember, all of these have corresponding Ind ASs. Like you might say something as consolidation, but basically in your inter-CA consolidation was AS 21. You can say amalgamation, but amalgamation was based on AS 14. So basically all of these topics are based on their respective Ind ASs, which we will do. Like share-based payments is based on an Ind AS 102. This will come for anywhere between 6 to 8 marks. Now you might say, hey, 6 to 8 marks. Remember, that can be the difference between 400 and 399. So you have to be respecting each and every mark. 6 to 8 marks is also very valuable, and in fact these are easy marks, so this is something that you should also cover. So 6 to 8 marks, a question on average in every paper coming from share-based payment, something which is very similar to what you would have done in ESOP in your inter-CA. This is your 26. So if you see the latter part of your book from I think 24, 25 or something, you will have a lot of assured weightage topics, 6 to 8 marks. But that does not mean you don't study everything else, but I'm just giving you what is almost certainly going to come. Then you will have the 2 most recent additions to your syllabus. Ind AS 115, which is on revenue recognition, came I think in the year 2019. and Ind AS 116, which is on leases, came in the year 2020. In almost every exam that has come, you have had a question on Ind AS 115 as well as Ind AS 116 because they are fairly complex as well as exhaustive. So you will have anywhere between a 10 to 18 mark weightage over here, maybe a 12 to 18 mark combined weightage. So maybe a 8 to 10 mark question on Ind AS 115 and maybe a similar weightage question on Ind AS 116. So you can say 12 to 18 marks from these two topics. So over here you will have Ind AS 115 and 116, topic number 24, topic number 25 together, anywhere between 12 to 18 marks will come from these two topics. Are you guys following? Any problems, any issues, any technical problems? Yes, no, something that can be written? नहीं, हम बहुत भाव खाएंगे. No? Chalo, great. So over here, then there is, so all of these I would say are linked to some of the other Ind ASs. There are only two topics in your entire curriculum which are not connected with Ind AS. So over here, these are CSR. Let me just drag this down. These topics are corporate social responsibility. Have you heard about CSR before? Yes? Okay. CSR, and there is something called as integrated reporting. These are largely theory based topics and these are the only non-Ind AS topics. So if institute wants to give you a small break from Ind AS, this is the only respite that they have, at least currently. Going forward, we don't really have the exact details of the new course, but in case that course, if and when it becomes applicable, it is expected that there will be a small section even on ethics that will come. Again, it will not be a huge portion of your syllabus, but again a smaller portion may be devoted towards ethics in your accounting and in your other topics as well. So over here, this is around 4 to 6 marks. You have generally got a question of around 4 to 6 marks over here, and this is on your index. If you go to see 31 and 32, this together is 4 to 6 marks. So basically, if I look at topics from 24, so these are topics all the way that I've written over here. These are topics from in your index from 24 on your shield to around 32 on your shield. So these are the topics, and the weightage, and these are almost certain weightages, would be, let us say 15, 20, 6, 12 and 4. On a minimum, you will get around 55 or 57 marks. Remember, your total paper is around 120 marks. Sir, 100 marks ka paper hota. Yes, but you have an optional question. So when we give the weightage, it is for the entire 120 marks. When we do the breakdowns, out of 120 marks, let us say 55 to, if you go to see on the upper end, in certain cases, this may be overly optimistic, but nevertheless, close to 75 marks, 75 or 80 marks roughly, will come from these topics. So studying these topics alone can give you exemption marks. Sir, so we will not refer the first topics. No, remember, these topics are important, but at the same time, they are the most complex topics in your entire syllabus. So, I mean, I would recommend you to study everything, but if you're studying just these, you're actually taking a much more riskier bet because you're going to be tested on a much more intense topic. Yes, you're sure this is going to come, but this is a much more complex topic. The first 24 are widely dispersed. Now, you would appreciate that out of these topics, the institute cannot ask each and every topic. There would be certain important topics, there would be less important ones, but it can't ask everything because, well, there are just too many topics and there's just 100 marks, 120 marks for you to ask. So all other Ind ASs, all your other Ind ASs, which on your index goes roughly from topic number 1 all the way up to topic number 23, and also at the end there is some conceptual framework and analysis. So you might have topic number 33 and 34 over here. All of them together would account for the remainder of the marks. The remainder of the marks again can be anywhere between, let us say, around 50 to 60 marks approximately. Remember, we are not doing a mathematical tie-up here. It has to be 120. I'm just giving you approximate ranges. So anywhere between 50 to 60 marks, sometimes even more, can come from the other topics. So again, even these topics alone can help you cross the line and sometimes even secure an exemption. But remember, these indices are relatively simpler, but they don't have an assured exam weightage. The other topics are relatively complex, but they do have an assured exam weightage. In terms of your main exams, almost your entire exam is going to be a practical exam. So when we say a practical exam, it will be a mix of sums, like in your inter-CA, you might have done sums on EPS, earnings per share, or it may be a mix of cases where sometimes similar to what you have done in your inter-CA, you might have a case where you might be asked on whether you should have a contingent liability, you should create a provision, you should give a disclosure. So you might have a case study. In the new course, there might be a small change where you get MCQs, but even if you get MCQs, you should be happy. It increases the speed of your paper, you have more options. But even for MCQs, you don't need a separate skill set. You need a detailed understanding of the standard, whether it is a case, whether it is a sum, or whether it is an MCQ. So nothing changes on that level. If required, we will do a separate practice for MCQs and share question banks for MCQs as well if they are applicable, or irrespective of them being applicable for your practice. So over here, in terms of your paper, at max, the only theory that you can get in your paper can come from integrated reporting for around 4 to 6 marks. If I remove this, your entire paper is going to be having sums, or it is going to have cases. So you will not have theory, like if I'm not sure if you have done SFM or if you have done costing, SCMP, you'll have a lot of theory in that. SFM has close to 20 marks of assured theory in your main exam, costing a lot more, SCMP. So over here, your financial reporting paper is going to be a lot more application-based paper than a theory-based paper, where you will have to apply what you know in cases, and you will have to kind of you'll have to solve sums. This is something which is very interesting, and at a lot of places, a lot of your senior chartered accountants who have always done a lot of accounting standards, you can really advise them because of your knowledge of Ind AS. This is something which does not come naturally to them, but should come naturally to you. Okay. So that is about the weightage. We will be sharing the board notes as well. So whatever I write on the screen, I will be sharing that through a separate Google Drive link. So in case you prefer noting them down, you should note them down. What you want to do later, you might as well do it today. Or if you are fairly lazy, you're just still in your bed watching the lecture, which I don't recommend, but these are the realities. So you can probably jot this down or refer this later as well. We will be sharing everything that I write on the screen through a separate link. Okay, so are we clear on the coverage? So if you see the first 23 odd topics, you'll see a lot of Ind ASs. Ind AS 1, 2, 7, 8, 10, 12, blah, 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 going up to Ind AS 41. Then अपन सीधा century मार देते हैं. We go to Ind AS 101, 105, 108, 113, etc. Okay. Before we start with Ind ASs, we want to give a general background as well on what is Ind AS. But are we clear with the broad coverage of our subject? Any problems? Chalo, theek hai. Now the next section that we go to, again this is not asked in your main exams generally, but this is something that you should be aware of, and sometimes it might even land up. So what is the applicability of Ind AS? Okay. Just a second. How many of you have done Ind AS in practice in your articleship? How many of you have done Ind AS? We have some of them who have done Ind AS. I can see most of you have not done Ind AS. From the poll you can see, I can see around just 20% of you have done Ind AS in practice. 80% of you seem to have not done Ind AS. Maybe it is because you're doing tax, maybe you are under audit, or maybe, let us say a third assumption, you're doing a dummy. I think you are not, but nevertheless, you're more probably in tax. But if you're in audit, why would you not have done an Ind AS? Okay, this is an interesting thing, because unlike GST, which applies almost across the board, so it replaces service tax and VAT largely, Ind AS does not replace the accounting framework currently. A lot of you are in audit might have also done accounting standards based audit even as we speak. That is because Ind AS is not applicable to every company. To a lot of companies, AS, accounting standards, are applicable, which you might have done in your inter-CA. So institute, that is why your CA final FR syllabus is so big. Institute has to teach you full AS, which it does in your inter-CA, and then it has to teach you the entire Ind AS, which it manages to do in your final CA. Well, inter-CA had 2 subjects, 200 marks for accounts. Final CA is just 1 subject, but the coverage is almost the same. So what you're studying now is an equivalent of around 2 subjects. So we have to do all the Ind ASs because they are not applicable across the board. So to whom is Ind AS applicable? According to you, Ind AS is applicable to larger companies, or is it applicable to the smaller companies? What do you guys think? Ind ASs, if they're not applicable to all the companies, to whom should it be applicable? To the larger companies or to the smaller companies? Well, almost all of you mentioned that it should be applicable to the larger companies. Why? Because Ind AS is new, relatively new. It is based on an international framework for which you need talented chartered accountants like you who are studying. So once we have an adequate workforce, manpower who is competent with Ind AS, we can apply it across the board, and hence the applicability of Ind AS as we speak is restricted to the larger companies. As you mentioned, it is restricted to the larger companies, and hence if you are working in a small CA firm which does not have these large clients, you might have still done audits based on accounting standards, whereas if you are working in relatively larger mid-sized firms or even the big 4, you would have done a lot of Ind AS because they would have slightly larger clients. Eventually the plan is to move everything into a single reporting framework, that is the Ind AS, but for that we need some time, for which adequate manpower workforce needs to be first equipped. Okay, so as we say, Ind AS is applicable to larger companies, but before we go there, why should Ind AS come in the first place? Acha khasa accounting standards was going. In inter-CA we have done accounting standards. Why do you need accounting standards? You need it for the purpose of standardization. Because if there are 2 financial companies, statements of 2 companies, and you want to make a decision, let's say there are 2 competing companies like Parle and Britannia, both of them are manufacturing biscuits. Sir, सुबह सुबह भूख लग रहा है, हाँ आप तो खा ही सकते हो. It's difficult for me to eat while teaching, but otherwise आप तो खा ही सकते हो. So over here, if there are 2 financial statements of Parle and Britannia, I want to decide which of the 2 companies should I put my money in. Now I need to compare their performance, and if I need to compare their performance, their profits, their investments, their assets, their capital, they have to be based on a similar accounting framework, and hence we need standardization. We need standardization to prepare our financial statements, and hence is the need for accounting standards, so that different statements are reported in the same manner. Now, so for that reporting, we had our accounting standards. Now, why do we need Ind AS in the first place? Can you guys tell me what was the need to move from AS to Ind AS? In short, why was the need to even move from AS? Because AS is fairly good. We have studied that in our inter-CA. We have faced some difficulties, but it was fairly good. Why do we need to move from AS to, let us say, Ind AS? Okay. Uniformity with IFRS. Okay, fair point. Now, I'll just take a different reference for your understanding. Let us say, अभी अपन CA clear हो गए, and we are told that someone, you can go for a vacation. Where do Indians typically head out for a vacation? Generally, I would just generally say, better framework, global standards, yes, but अभी अपन exam खत्म होने पे पहुंच जाता है, clear हो गए अपन. And then we have to go abroad, not in India. If you have to go overseas, where would you typically go for a vacation, or where do Indians typically flock if you go to sea for a lot of vacations? You would see a lot of Indians going to, let us say, the UK, the US, Australia, New Zealand, a lot of these. अपन तो सोच में अपने तो पहुंच गए. We are preparing our Instagram reels over there. Come back to reality. But a lot of times, a lot of people go to the Europe, US, UK, Australia, New Zealand. You hear a lot of people going to South Korea, Dubai as well, yes, Singapore, South Korea, Japan, China. Do you see a lot of people going over there? Well, relatively few. I mean, there would be people who going, but relatively few. What is the thing? I mean, South Korea, Japan, etc. is beautiful. China is a different story now, different narrative these days, but nevertheless, they are beautiful countries. Why don't people go over there? There's a lot of reasons why people don't go, starting with the language barrier. You have a big language barrier. If you just have to even go for a 6 days, 7 nights, 7 days tour, you would say, नहीं यार, language नहीं समझ में आएगा, we will not know what they are speaking, यार खाने को कुछ दे दिया, निकलेगा अंदर से कुछ और. We don't know what is written. We are reluctant. We are reluctant to even go there for a week because we don't understand their language as well. However, if you are in the US, UK, Europe, Australia, New Zealand, etc., most of these places, the language barrier is relatively less because most of the places, at least a few of the people would understand English. And as a result, we might as well prefer going into a company. So most of the Indians would prefer going into countries rather. अपन ने बहुत पढ़ाई कर लिया, company दिख रहा सब जगह पे. We'll prefer going into countries where we understand the language. If that goes for a 6-day, 7-night package, well, if I have to invest tens of crores or millions of dollars, I might as well invest that into a company which speaks my language. Sir, company speaking language. The language of companies is financial statements. The language that they speak is the standards that are being followed. So if I am following accounting standards, an investor in the US or investor in Europe who wants to invest his money in India, he's comparing an Indian company with, let us say, a Middle Eastern company. Now, a Middle Eastern company has prepared its financials as per IFRS, which is something that an international investor understands. If you study ACCA, if you study CFA, if you study any of these, you will be taught IFRS everywhere. An international investor understands IFRS, International Financial Reporting Standards. Close to 120 countries globally, including Australia, New Zealand, the entire Europe, all of them follow IFRS. So they understand what IFRS is, and hence they will consider going to your company / your country. If it is accounting standards, well, they don't know. So they would say that, yeah, they have prepared it as per accounting standards, but I don't know what is written in our accounting standards. I don't know the provisions, so let us keep them away. And hence a lot of foreign investors. And India needs a lot of FDI as well as a lot of FII. Foreign direct investment, foreign institutional investment, and hence we need to speak the language which a foreign investor will also understand. And as a result, we need to converge to move from accounting standards into international financial reporting standards. Do we understand the reason? Yes. Do we understand the reason? Yes, largely we need to make our companies speak the language which an international investor will also understand, and hence that is the need to move to Ind AS and depart from AS. There are more than 300 differences between AS and Ind AS. But sir, then why is it called Ind AS? It should be IFRS. Yes, it has to be IFRS. However, remember, IFRS was developed by International Accounting Standards Board, IASB, which is sitting inside the UK in the Europe, which is a developed country. And remember, the problems that developed countries face are slightly different as compared to the problems that a developing country faces. To start with, something as basic as inflation. As you might have seen a lot of rent agreements, there would be typically an escalation clause in our rent agreements. Yes or no? In most of the rent agreements that you would have seen, there might be escalation clauses. Are yes or no? Because India's inflation is relatively high. However, inflation is not that big a deal, or at least was not that big a deal in the developed countries. Today is an exceptional phase, but generally their inflation would be around 0.1%, 0.2%, 0.35%, less than 1% in all likelihood. अभी उसके लिए क्या escalation डालने का? अपने को शर्म आएगा 0.5% का escalation करने का. So they don't have typically escalation clauses, and hence the problems that come along with escalation clauses, let's say in rent agreements, leases, etc., may not be there under a developed country, and hence they might not have covered it, but would be there in a developing country. And as a result, there would be certain treatments which we in India are not comfortable with as compared to what is there in IFRS, and hence we have created what you call as carve-outs. Carve-outs means there is this entire statute. Forgive me for my extremely bad drawing skills, but I think that is not the reason why you are here. But nevertheless, let us say there is a statue. Now you don't like a particular part of the statue, so you replace that part by a new part. So you're carving out a part of the statue with a part that you think is more appropriate. This is a carve-out. There are close to just 12 to 13 carve-outs, which is the difference between IFRS and Ind AS, and hence we are not saying that India is following IFRS. We are saying India converges to IFRS, which means that there was close to 300, 400 differences earlier. Now we are following IFRS in all likelihood with a few exceptions. And these exceptions, we create carve-outs. That's a 12 or 13 page document that a foreign investor can read. And once a foreign investor reads the document, well, they know what Ind AS is. Everything else, including the para numbers, the standard numbers, are exactly the same as what is there in IFRS. And hence you see such weird numbers. Just say AS was 1, 2, 3, 4, 5 in a chronological sequence. आपने ऑडिट में भी पढ़ा रहेगा दी एसेज दैट आर देयर, कुछ भी वाहियात सीक्वेंस में दिए हुए. इन अ सिमिलर वे इफ यू सी ओवर हियर 1 2 लॉजिकली 2 के बाद यू गेट 3, वेल वी गेट 7 ओवर हियर, 8 you get 9, now we get 10 over here. This sequence we have kept, which is exactly in line with the international accounting standards. So for example, if I look at Ind AS 19, it will be exactly same as IAS, International Accounting Standards 19. If I look at Ind AS 21, it will be exactly same as IAS 21. So to keep it consistent with an international standard, so a foreign investor would say foreign exchange, Ind AS 21, IAS 21, they would know that foreign exchange would be covered under this respective standard. Now, just for your knowledge, and if you're giving the elective paper 6E, which is on GFRS, this would help you. I mean, just basic, GFRS is the same as financial reporting. After Ind AS 41, you directly jump to Ind AS 101. Why is that? Well, because standards which were issued prior to, I think 2005 or 6, I don't remember the date as clearly, but prior to 2000s, these standards were called as IAS, International Accounting Standards, IAS, and the standards which were issued after that were called as IFRS. So IFRS is International Financial Reporting Standards, which were issued, I think, after 2005 or 2006. All of the standards were called as IFRS. So this is IFRS 1, now becomes Ind AS 101. IFRS 8, becomes Ind AS 108. Sir, why have we given 101? Because we already have an Ind AS 1. So if I also give this as IFRS 1 as Ind AS 1, sir, but this was International Accounting Standard IAS 1, presentation of financial statements. This 101, first time adoption, is IFRS 1. So IFRS are the standards which were issued after, I think, 2005 or 6. IAS was standards issued before that. Now we are adopting everything, and hence we don't want to create that confusion of calling standards differently, so we just number them differently. So the standards after 100 series, when you see 101, that is IFRS 1, 103, that's IFRS 3, 108, that's IFRS 8, 115, Ind AS 115, that's IFRS 15. This is just for your knowledge, so that you are aware of what you are studying in a global practical framework as well. So we just don't want to finish off the course. We would want you to give a lot of practical perspective as well. Are we clear with this? Any problems? Do we understand why do we need Ind AS? Okay, great. Now we do need Ind AS, as we have mentioned, but we said this would be applicable to larger companies. Okay, so there is a phase-wise applicability. There is a phase-wise applicability for Ind AS. When did Ind AS become applicable? So the first phase came in the year 15-16. This is a good 5 to 7 years, 7 odd years back, when you were probably preparing for your main schooling exams. So over here, schooling, or maybe you are preparing for your boards, whatever it is. So this is in the year 15-16. Ind AS was introduced for the first time, and it was kept voluntary, which means whichever company wants to adopt Ind AS, they can do that on a voluntary basis. There was nothing mandatory. You would have seen the success of something. So the missing IAS numbers are not applicable for India. The missing IAS numbers are not there only. So if I look at, for example, between Ind AS 2 and Ind AS 7, ideally there should be IAS 3, IAS 4, IAS 5, IAS 6. If you go to international standards, there are no such standards. Maybe they were there in the earlier years and they were removed, but there is nothing. Like, for example, in your Inter-C, if you remember, there is AS 5. After AS 5, there is directly AS 7. There is no AS 6, because earlier there was AS 6 called as depreciation, and then depreciation was merged into the PPE standard, and hence AS 6 hai hi nahi. Then AS 7 ke baad directly aata hai AS 9. There was no AS 8. Acha, there was earlier an AS 8 which was for research and development, but then research and development was merged inside intangible assets, and hence AS 8 is no longer there. So it's not that you are not studying the standards in the middle, there are no standards in the middle. Are we clear with that? Yes? Acha, 15-16 was the phase of voluntary applicability. If something is kept voluntary, आपको बोला कि देखो अभी लॉ आपको voluntarily पढ़ना है. They are saying that there will be a self-testing module, but if you have to study voluntarily, there would be some people who would do that, but the wide majority, unless a bullet is kept on their head, are not going to study for that. And as a result, the success of the voluntary applicability was very, very mild. I mean, there was barely any company, not even handful of companies which tried to do the voluntary framework. Arey chalta hai, jo chal raha hai chalne do. And hence we had to make the mandatory move. So in the year 16-17, Ind AS became mandatory. Now this is where panic spreads. Mandatory. Now you have to move to Ind AS. But who has to move to Ind AS? Well, companies which are listed or companies which are in the process of listing. Process of listing would mean they would have filed their prospectus, IPO documents, etc. Like a lot of issues, like recently, if I remember, LIC also got listed recently. There was Inox Green. There was there are a lot of issues which issue documents are filed. So they are in the process of listing, whether in India or even outside India. So there can be Indian companies which can even list outside India. Like you would have heard about Naukri.com or MakeMyTrip.com. These were pioneers of the Indian .com industry, but they were they were incorporated in the early 2000s when there was a .com bubble in the US. India में तभी internet भी barely किधर था, and hence they decided to list them in the US. So these are Indian companies by and large, but they're listed on the NASDAQ in the US. So if you are presenting financial statements in India, and you might be listed, let us say in India or outside India, it does not really matter. If you are listed or in the process of listing in or outside India, and your net worth exceeds, so if you are listed or in the process of listing in or outside India, and let us say your net worth is greater than 500 crores. How do you calculate net worth? We'll come to that. But if your net worth is greater than 500 crores, you are a fairly large company, then Ind AS becomes applicable. In the year 1617, for other companies, loosely speaking, the unlisted companies. Again, if your net worth is greater than 500 crores, Ind AS still becomes applicable. It is not that it is applicable only to the listed companies, even unlisted companies. Like Parle, for example, in India is a very big company, though unlisted. Basically, these are companies which can afford the big four. So they can afford international and big accountants as well. So we have said that, okay, you can start with applying Ind AS. Once you go from the year 1617, I'll just present it in a slightly different way. Mandatory applicability can come in the year 1617. Then when you go to the year 1718, that is the next year, the limits would be lower. So you will try to cover even more companies into your net. So in the year 1718, that is the next year, companies which are listed or in the process of listing, whether in or outside India, all the companies, irrespective of the net worth, all the companies, irrespective of NW, that is a net worth, will have to follow Ind AS. All companies. Now there is a small exception to this, but that's not really relevant from an exam standpoint. Companies which are listed on the SME platform, small and medium enterprise platform, on the BSE or the NSE will not be covered. However, all other companies, irrespective of their net worth, almost every company that you have heard about is listed on the main platform, and hence we will keep our discussion restricted to that. So for all practical purposes, all companies will have to comply with Ind AS which are listed, and as a result, all of these companies are now presenting financial statements under Ind AS. So if you have a listed client, you will be seeing that it is preparing accounts as per Ind AS. For the other companies, you will have a 250 crore net worth limit. So over here, other companies, unlisted companies with a greater than 250 crore limit will have to follow Ind AS. Sir, after the year 1718, well, nothing has been given as of now. So the applicability limit is for 1718 onwards, which means if you are a company which had a lower net worth, but now your company is doing really well after, let us say, COVID, let's say something like the Serum Institute of India, who is manufacturing the COVID-19 vaccines, or someone like Zoom, who might not have as big a net worth, but after COVID-19, they have done exceptionally well. Zoom is listed, by the way, in the US, but I'm just giving you an example, okay? This is just for academic discussion. Let us say Zoom was an Indian company, unlisted. Then after, let's say in the year 21-22, its net worth crosses 250 crores, Ind AS will become applicable. So over here, for unlisted companies, the limit is 250 crores and above. For listed companies, there is no limit. The moment you get yourself listed or you are in the process of listing, you have to move your accounts into Ind AS. Are we clear with this? Yes? Okay. Now, how do you calculate net worth? A few things, a lot of things on the applicability we want to discuss. Now we go to the finer points. Yes? Okay. Thank you very much. Please do answer. Make it a little more interactive. उसके पैसे नहीं लगते अपने को आंसर करने के, ज़्यादा भाव नहीं खाने का, थोड़ा बहुत आंसर कर सकते हैं अपन भी, हमको भी अच्छा लगेगा. We know that you are awake and I'm not been successful in putting you to sleep. So over here, let us say we go to the finer points. How do you calculate a net worth? Okay, obviously net worth will include share capital. When we say share capital, that can be equity share capital as well as preference share capital. It will include reserves and surplus. Almost all reserves are included except for something like revaluation reserve, which is not really a reserve. So it includes reserves and surplus excluding revaluation reserve. You guys tell me, should borrowings be a part of your net worth? Long-term borrowings like debentures, etc., should they be a part of your net worth? Should they be a part of your net worth? Borrowings? Well, no. Borrowing should not be a part of your net worth. Reserves. Borrowings do not belong to the owners. They are like liabilities. And hence, share capital plus reserves minus any fictitious assets. Like in certain cases, you might see preliminary expenses not yet written off, underwriting commission not yet written off, if there are any, or P&L debit balance. So if there are, these are called as fictitious assets. They are not real assets like building, property, inventory, goodwill also. They are all real assets. Any fictitious items like expenses not written off, if any, they are expenses, they will reduce the reserves. Fictitious assets you will reduce. So over here, fictitious assets being something like preliminary expenses not written off. This will give you the net worth. Which net worth should you look at? Well, you should look at the net worth as per the last audited balance sheet. So if as per the last audited balance sheet, the net worth crosses 250 crores. So we are not in the year 17-18 anymore. So we don't have to bother about that. Let us say when you are going to write the exam, in all likelihood, you will write the exam with the year 23-24, or you might write the exam with the year 24-25. So will Ind AS become applicable to your client in the year 23-24? Well, if your client decides to get itself listed, Ind AS will become applicable. Or if your client's last audited balance sheet has a net worth of 250 crores or above, even if it is unlisted, Ind AS will become applicable. Are we clear with this? So you guys tell me, the net worth over here that we are referring to should be the standalone net worth, or should it be the consolidated net worth? You might have seen standalone and consolidated balance sheets. What do you guys think? The net worth that you take as 250 crores, should it be the standalone net worth or should it be the consolidated net worth? I can see a mixed verdict over here, almost a 50-50 verdict where students are saying between standalone and consolidated. Okay, the answer is it has to be standalone. The net worth that you see should be based on the standalone. What is the reason for that? Well, remember, almost every regulatory thing that you see is based on standalone. Like you might have heard about PAN, permanent account number, that is unique to every company, not company and all of its subsidiaries together. Every company has a separate PAN, or for companies act as a UCIN, unique corporate identification number, which is unique to every company. And as a result, when you have to test the limit, you have to test it for every company individually. Every company individually will have a separate balance sheet, and hence you will test it separately on a standalone basis, not on a consolidated basis. This has also been clarified. So over here we will create a standalone net worth of approximately standalone net worth of approximately 250 crores or above. Net worth will comprise of share capital, reserves and fictitious assets. Subtracting the fictitious assets, you will not have borrowed funds, etc. Okay, so this is how you calculate net worth as per the last audited balance sheet and based on the standalone net worth, not the consolidated one. Okay. Now let us say you are a small company, but अपने पास कीड़े थोड़े ज़्यादा हैं. We say कि if there is an emerging trend, we want to go with that trend. So over here, let us say you decide to voluntarily apply Ind AS. Your net worth is just 100 crores. वो भी कोई छोटा नहीं है, but let us say it is 100 crores, or even if it is 1 crore, 10 crore. You want to voluntarily apply Ind AS. What do you guys think? Will you be permitted to voluntarily apply Ind AS if you want to? Yes, you are doing something which is more in trends, and hence the standards allow you to apply Ind AS voluntarily. So voluntary application is possible, mandatory application possible. However, whether you have applied Ind AS voluntarily or mandatorily, you want to now move out of Ind AS. You want to now move out of Ind AS. Sir, why do I want to move out of Ind AS? Probably I am now delisting myself. Companies do delist themselves. Like maybe Twitter might get delisted after Elon Musk takeover. We don't know. You might delist the company, so it is now unlisted, or your net worth was about 250 crores. However, there was a huge loss, etc., and your net worth plummets. It goes below 250 crores. What do you guys think? Will you be given a choice of moving out of Ind AS? No. Remember, once Ind AS is applicable, it sticks to you. You will not be able to move out of Ind AS once it becomes applicable. This even applies to voluntary application. Apne josh mein aake you applied Ind AS, and now you said nahi, humse na ho pai. Ind AS is not something that we can do. But if you have prepared Ind AS financial statements earlier, whether voluntarily or mandatorily, Ind AS will stick to you. You cannot move out of Ind AS then. Are we absolutely clear with this? Yes, and as a result, over here, companies will, once Ind AS becomes applicable, whether on a voluntary basis or on a mandatory basis, Ind AS will continue. Then you cannot move out of Ind AS into the AS framework back again. So this is one more special point that you should be aware of. Okay. Now, one very important thing that you need to be aware of would be the applicability, let us say, of Ind AS on a group. We are yet to study consolidation, but when we look at a group, you see over here, let us say there is, for a group, there is a parent company, let's say P. A parent company might have, let us say, S1 as subsidiary 1, S2 as subsidiary 2. You can have someone like Reliance, and Reliance has Reliance Retail, Reliance Jio. Let's say, for simplicity, it holds 100% stake, so it's a subsidiary. Even if it holds an 80% stake, it is a subsidiary. It has, let us say, 30% stake in another company. This is called an associate. Have you heard about the words associate? We'll do that later. But if you have more than 20% stake in a company, but probably less than 51% stake, that is an associate. You have significant influence in that company. That is called an associate. Or there can be a joint venture. Sir, what is a joint venture? Well, it's a joint arrangement like Hero Honda, which was there earlier, or Bajaj Allianz. You see Tata AIG. All of these are joint ventures. So over here, there is a joint venture where there is a partnership where both of the parties have agreed to work together, let us say. These are called as entities which are forming a part of a larger group. Now, you might make investment in 100 shares of Aditya Birla, 50 shares of Apollo Tyres. All of these are not your group companies. They are just merely investments. However, these companies like subsidiaries, they are under your control. Associates, you can significantly influence. Joint ventures, they are your partnership entities. Like Maruti Suzuki. So all of these, we would say, are entities within a group. Now, when we are looking at, let's say, parent, SFS, the standalone net worth, let us say all of these companies are unlisted. The SFS of the parent, for example, net worth is 300 crores. Will Ind AS become applicable to the parent? You guys tell me, will Ind AS become applicable to the parent? Yes or no? Fatafat answer karenge. Yes, applicable. Let us say S1 subsidiary has a standalone net worth of 100 crores. From what you have studied till now, will Ind AS become applicable to subsidiary S1? 100 crores? No, it will not become applicable. Now, whether it is subsidiary, whether it is associate, whether it is joint venture, ideally, based on the net worth criteria, parent will be following Ind AS, but subsidiary can follow AS. Now, do you think this is feasible? Do you think preparing consolidated financial statements is mandatory? Do you think preparing CFS is mandatory? Well, yes, it is mandatory. If you have even one subsidiary, you will have to prepare consolidated financial statements. Now, what will happen is when I will do consolidation, I'll have to do consolidation based on uniform accounting policies. So, parents' policies are Ind AS, but subsidiaries policies are AS. I'll have to restate the subsidiaries policies as per Ind AS, then do consolidation. Now, rather than doing all of this headache, the standards have told you that if Ind AS becomes applicable to one of the entities in your group, it need not be the parent entity, it can even be one of the subsidiaries. Like it is possible that parent has a smaller net worth, but one of the subsidiaries, S2, has a net worth of 300 crores. Parent only has a net worth of, let us say, 150 crores. If one of the entities in your group is covered under Ind AS, all entities in your group will be covered under Ind AS. Sir, nahi samajh mein aa raha. I mean, loosely speaking, when COVID happened, when one of the family members tested COVID positive, आपका पूरा घर सील किया जाता था. वो फैमिली मेंबर को तो चलो अपन एक रूम के अंदर बंद करके रख देंगे, बट फिर वो पूरा फैमिली भी क्वारंटाइन में चले जाता था. Now things have changed dramatically, but nevertheless, when we say that entire family would be quarantined, it is similar to that. So if one member of your group tests positive for Ind AS, the entire group will have to follow Ind AS. Is this mandatory or this is optional? Sir, this is mandatory. Ind AS has specifically mentioned that if it becomes applicable to one of the members in your group, it will by default apply to all the other members in the group as well. So all the joint ventures, all the associates, all the subsidiaries, the parent company, all of them will have to comply with Ind AS, and probably that is why a lot of your clients you might have seen who are subsidiaries of listed companies, they might be individually fairly small, but even these subsidiaries would follow Ind AS because a parent company which is listed is following Ind AS. Are we clear with this? It is mandatory to follow that treatment. The standards, MCA, Ministry of Company Affairs, has required that to be done. Now, there are certain exceptions over here, but probably we'll come to that at a later part of your course once you understand the detailing slightly better. We're just like there is something called as a joint operation, not a joint venture. We don't know as of now the difference between a joint venture or a joint operation. So this will apply to a joint venture, not to a joint operation. But we have not studied what is a joint operation, so there's no point going into that. At the appropriate place, we will come back to this page and we will discuss that as well. Are we clear with this? Achha, your company might be a charitable organization as well. A lot of these charitable organizations, like someone like ISKCON, for example, can also be a company. So, if there is a company like ISKCON who is probably for a charitable purpose, but ISKCON being ISKCON has a net worth of greater than, let us say, 250 crores. Will Ind AS become applicable even to a charitable organization? What do you guys think? Yes, the standards don't differentiate between a for-profit or a not-for-profit organization. Like if it is a company covered under the Companies Act, which has to prepare accounts as per specified standards. If its net worth is greater than 250 crores, whether it is objective is for profit or not for profit, Ind AS will become applicable. Again, if it becomes applicable to one of the companies in the group, it will become applicable to all the other companies in the group as well. So, in terms of applicability, so we have discussed the key points. So, if you go to your applicability page, we'll not read each and everything. I'll keep that for you. Again, this is a fast track batch. We will discuss conceptually everything that I've discussed is covered in this page, but you can read this preferably on the same day. It will not take more than half an hour to 1 hour of your time, but read that so that the concepts that we discussed in class are cemented into your mind, and if there are any queries, you can get back to me on the very same day as well. So over here, the applicability of Ind AS, as we have said, phase-wise applicability in the year 15-16, it is voluntary. In the year 16-17, it is mandatory for listed as well as unlisted companies having a net worth of greater than 500 crores. For the year 17-18 onwards, it becomes mandatory for all listed companies and for unlisted companies having a net worth of greater than 250 crores. Key points over here: net worth is calculated based on the share capital plus reserves excluding the revaluation reserve minus fictitious assets. This net worth is to be based on the last audited balance sheet, and it has to be based on the standalone net worth. Ind AS can be applied voluntarily or mandatorily. However, if an entity prepares voluntary statements, it will be covered under Ind AS. It cannot go back later. if Ind AS becomes applicable, this is an important point. If Ind AS becomes applicable to one of the entities in the group, it would become applicable to other entities as well, like subsidiaries, associates, joint ventures, etc. It will become applicable. Sir, but what if the companies are not covered under Ind AS? Well, then they will continue to apply and prepare their accounts as per AS, accounting standards. Okay, now there is another point which is not going to come for your exam, but this is something which should feed into your curiosity, especially if you have done stuff practically. The above framework applies to general companies. जैसे अपन X Limited देखते हैं. In Inter CA you might have studied about special provisions being applicable to NBFCs, non-banking financial corporations. Special provisions being applicable to banks. Insurance companies was earlier there, it was removed. So to banks, NBFCs which are governed by RBI, insurance companies which are covered by IRDA, Insurance Regulatory Development Authority. For these companies, as you would be aware, the structure of the balance sheet, the items, etc. are not the one that you follow as per Schedule 3 Companies Act. They have a separate framework, and as a result, till now, RBI has been continuously differing. Ind AS is not applicable to banks as we speak. To insurance companies as well, as we speak, Ind AS is not applicable. It may become applicable at a later date, but till now it has not become applicable. So these frameworks don't apply to banks and insurance companies. NBFCs, they have started becoming applicable, but there's a slightly different phase. But banks and insurance companies, Ind AS is still not applicable, and hence banks and insurance companies, accounts are prepared as per accounting standards. So do we ever get a question on banks or insurance companies? Never. Not even a sub question till now, or even any institute case has come on banks or insurance companies or even NBFCs. But for your academic understanding, it is important that you are aware that the above framework is for a general company like X Limited, A Limited, B Limited, not for a bank, not for a insurance company. Are we clear with this? No, etc. is just general thing. So subsidiaries के नीचे भी अगर कोई subsidiary हुआ, sub-subsidiary, for example, so over here you'll have A के नीचे S1, S1 के नीचे S2. So S2 is also covered. So it's just a generic thing basically. So the above roadmap is not applicable for banks, insurance companies, NBFCs, as a separate roadmap is prescribed. As we speak, Ind AS now becomes applicable to NBFCs, non-banking financial corporations, but it is not applicable to banks and insurance companies. Ind AS is applicable irrespective of the entity being a charitable organization or not. Joint operation is something that we have not yet studied, so I'll keep it aside for the time being. There's a key point: joint operation of an Ind AS entity need not comply with Ind AS, but we don't know what a joint operation is. We will come to that at the right stage and we will come back to this point. Other than that, is everything clear? Acha. On the next page, you have applicability for banks, insurance companies, and NBFCs. So for insurance companies, for banks, the applicability has been deferred till further notice by IRDA. For banks, it has been deferred till further notice by the RBI. So till the time these notifications come, they will continue to apply their accounting standards as per previous gap. For NBFCs, the applicability is plus 2 years. Everything remains the same, but to what you have studied over here, if I add 2, which is not a difficult exercise, instead of 16-17, this will be 2018-19. Instead of 17-18, this will be 2019-20. This is for an NBFC. So NBFC limits are the same. As we speak, all listed NBFCs like Sundaram Finance, Cholamandalam Finance, Bajaj Finance, all of these are listed NBFCs. Now, I mean, NBFCs, banks you have done in your Inter CA, but the difference between NBFC and banks largely is an NBFC cannot accept demand deposit. You cannot open a current and a savings account in an NBFC. You can probably do that in a bank. So over here, NBFCs, applicability is plus 2 years. So as of now, all listed NBFCs other than those listed on the SME stock exchange will have to mandatorily apply Ind AS, and unlisted NBFCs which have a net worth of greater than 250 crores will also apply Ind AS. Remember, voluntary application of Ind AS by smaller NBFC is prohibited. So over here, if you're a smaller NBFC with a net worth of, let us say, 100 crores, RBI said you cannot follow Ind AS. It's not that आपको अभी शौक है तो आप follow करो. No, you cannot do that. So over here, for NBFCs in the year 1819, listed or unlisted greater than 500 crores, and for the year 1920 onwards, all listed companies and unlisted with a greater than 250 crores. This will be applicable for these. This is deferred until further notice by RDA, deferred until further notice by RBI. This is already written separately for insurance companies and banks, so you don't need anything below this. So these are the two applicabilities. Remember, you don't have an option to continue voluntarily for NBFCs. Are we clear with this? Can we proceed further? Yes? Is everyone clear? Acha. Now, again, this is not really relevant from an exam or a syllabus perspective. However, there may be certain companies where they might have subsidiaries as banks, subsidiaries as insurance companies. Let's say there is Future Group, and in the Future Group, there are a lot of companies. Like Pantaloons was earlier there, they've sold it, but Big Bazaar was earlier there, they've sold it. But one of the companies over here will be Future General Insurance. Now, the problem will arise, this is just a very technical aspect, that insurance companies, Ind AS is not applicable. And hence, in the books of Future General Insurance, ideally, even in the SFS, they would follow AS, accounting standards. Let's say the Future Group's parent company is Future Group Limited, for example, which is listed, let us say, in which case they will follow Ind AS. Now, there is a conflict. Okay, sir, if the parent company is listed, the subsidiary will have to follow Ind AS. However, the subsidiary company is an insurance company. आपको समझ में आ रहा है मैं क्या बोल रहा हूँ? Are you understanding? So there is a conflict over here. How do we resolve this conflict? Well, the law specifically mentions that the insurance company is not covered by the Ind AS framework, and hence Future General Insurance or Future Generali, which is the actual company, Future General Insurance will have to prepare its SFS as per AS only. Sir, it is a subsidiary of a listed company. Let it be a subsidiary of listed company. It will have to prepare its SFS as per accounting standards only. But sir, what about consolidation? Well, at the stage of consolidation, the company will try to restate the accounts of this insurance company to Ind AS to the extent practical. To the extent practicable, the accounts of this company will be restated to Ind AS. So there will be an additional layer of effort. And once they are restated to the Ind AS to the extent practicable, that is when consolidation will proceed. Are we clear with this? So SFS will be, that's absolutely right. SFS will be based on AS, but for the purpose of CFS, you will restate to the extent practicable for the purpose of consolidated financial statements. Are we clear with this? Can we proceed further now into the main standards? Take care. Okay, then we will go to the next topic. We will now dive into the core accounting standards. We will start with Ind AS 16, property, plant and equipment. This is, have you studied a separate accounting standard for this earlier? In your AS, have you studied a separate accounting standard? Well, yes. This goes under the heading of AS 10. A similar accounting standard over here is Ind AS 16, property, plant and equipment. To what does this standard apply? Well, this applies to what you call loosely as fixed assets or tangible assets. So when we look at AS, this applies to fixed assets. Now, how do you define a property, plant and equipment? How do you define a fixed asset? What are the three essential qualities or characteristics? First, it has to be tangible. Tangible means it has physical substance. You can touch, feel and see. So it has to be tangible. Second, it has to be held for the purpose of use in the ordinary course of business. This use can be for production. For example, you have machinery in your factory that is held for your production use. It can be for administration. It can be for selling and distribution. So for example, you might have delivery vans. These For Pepsi or Coca-Cola, you see delivery vans. These are also property, plant and equipment. They're held for selling or distribution use, or they can be for administrative use, like laptops, which are used for your accounting or auditing employees. They're used for administrative use. All of these are held for use. Remember, it is not compulsory that these assets have to directly generate revenue. Like a laptop which is used by an accountant does not generate revenue directly. Or let us say there is the reception lobby of your office where you have put a beautiful painting that is not held for sale. It is held for use. Now that does not on its own generate more revenue. The standard does not say tangible assets or fixed assets are those assets which generate revenue. No, they are assets which are held for the purpose of use. Use can be anything. It can be administrative, it can be selling and distribution, it can be administrative, it can be production, it can be other use, like you might have to install pollution control equipment. So this pollution control equipment, in line with the emission norms of the country, reduces the pollution, which is also held for use. They are all covered under the heading of property, plant and equipment. So PP has to be something which is tangible. It is something which is held for the purpose of use in the ordinary course of business. Basically, it is not held for the purpose of sale in the ordinary course of business. Like for example, for most of the companies, cars are going to be held for the purpose of use, for transporting their employees, directors, etc. However, if you are Toyota, you manufacture cars. For Toyota, these cars are held for the purpose of sale in the ordinary course of business and not for the purpose of use in the ordinary course of business. Am I clear with this? And as a result, Toyota will classify these cars as inventory because they are holding it for the purpose of direct sale, not for the purpose of use. Okay, so these tangible assets should have a life of greater than 12 months. So the life has to be greater than 12 months for it to be covered under the heading of PP. Otherwise, you can just expense it off. There might be certain items which may be immaterial, or there may be certain items which have a life of more than 12 months as well. If they are immaterial, they can be expensed off. For example, something like this, your calculator. For a lot of people, calculator is something that you might be holding from your early foundation days, your same calculator. Do you hold the calculator for the purpose of sale? No. You hold it for the purpose of use. However, if you are working in a CA firm and a CA firm gives calculators to its employees, let's say a CA firm has 10 employees and to these 10 employees have given 10 calculators in total. Now, in total, every calculator may be worth 300 rupees if you buy original, or you know the price if you don't buy the original. In which case, this calculator might have a life of more than 12 months. It may be held for use, it is tangible, but it is immaterial and hence it might be expensed off as office expenses or printing and stationery. Again, materiality is something which is subjective, so it will be dependent on the management. From an exam perspective, everything is material unless the question tells you otherwise. So there may be certain items like pens, etc., which may be held for the purpose of use, but pens usually have a life of less than 12 months, pens, refills, etc. So you can show this as printing and stationery expense. So 3 criteria for you to be covered under PP. Criteria number 1, please repeat after me. Criteria number 1 would be tangible. Criteria number 2, held for the purpose of use, not for the purpose of sale. Criteria number 3, having a life of more than 12 months. If these 3 characteristics are fulfilled, we can say that this asset can be covered under the heading of property, plant and equipment, PPE. Are we clear with this? Yes? Okay. So this is basic, just overview, not really important. I'll tell you the important parts as and when they come. Remember, PP standard is a tier 1 category standard. When I say tier 1 category, it means that it is one of the most important standards from an exam perspective. There is a QR code. You can have a QR code scanner and you can scan this, and this will lead you to a summary video or an audio note in certain cases. So this is for your revision purposes. Right now you don't need to worry about these QR codes, but this is good for your reference. We'll take you through that separately. So over here, next you have the scope. Scope means what is covered under Ind AS 16, or more importantly, what is not covered under Ind AS 16. Usually those items for which there is a separate accounting standard will not be covered. So there is something called as non-current assets held for sale. Sir, come again. Non-current assets held for sale. Usually we hold inventory for the purpose of sale in the ordinary course of business. However, it is possible that there can be certain other non-current assets which you might hold for the purpose of sale. For example, let us say we are a coaching institute. You guys think and tell me, if I have benches in my classroom, if I have a classroom and I have benches in my classroom, will that be PPE or will that be will that be inventory? What do you guys think? If I have benches in my classroom, what would that be? Well, that would be covered under PP. That is not inventory because that is held for the purpose of use in the ordinary course of my business. However, for whatever reasons now, I decide to sell those benches. I say now a lot of things are happening online. I don't need these benches anymore. I decide to sell them. But if I want to sell them, it is not something that gets sold overnight. So the intention now is to sell this furniture. The intention is not to use this furniture. Now, can this furniture become my inventory? The intention now is to sell this furniture. Can this furniture now become my inventory? The answer is no. Sir, but I want to sell it. Well, yes, but you're not in the business of buying and selling furniture. And as a result, over here, this is not inventory, sir, but then, well, there's a separate accounting standard to cover these items called as non-current assets held for sale. You don't sell furniture or buildings or cars in the ordinary course of business, but some or the other day you might need to sell that furniture. And when you decide to do that, they're no longer held for use, but they're no longer held for the purpose of sale in the ordinary course of business. So it can't go under PPE because they're no longer held for use. It can't even go under inventory because they're not held for sale in the ordinary course of business, for which there's a separate accounting standard. This accounting standard is called as Ind AS 105, which is called as non-current assets held for sale. And hence we have said that, well, if there is this furniture which you no longer want to use, and if there are certain conditions that you will study under Ind AS 105, they are getting fulfilled, then this furniture is now going to be classified as a non-current asset held for sale. Ind AS 105 will become applicable. Are we clear with this? Very nice. So this is a non-current asset which is held for the purpose of sale. Second, remember in inter-CA law, you might have studied this provision that specific overrides general. Generally, these tangible assets like furniture held for use having a life of more than 12 months will be covered under Ind AS 16. However, if there's a specific standard like Ind AS 105 which covers these non-current assets which are held for sale, then the provisions of Ind AS 105 will be applicable. We will study these provisions at a later point. Second, exploratory and evaluatory assets linked to mining operations. These are covered under a separate accounting standard called as Ind AS 106. Now, what does this cover? Like, you look at these mines, they are dug up at a specific location. अपने KGF 2 देखा रहेगा? Sir, वो तो हमने देखा ही है. Rocky भाई का music is playing in our background. So over here, if I have to dig up a mine, I have to do a lot of exploration and evaluation to find that location where you think there will be a lot of mineral deposits. So what will you do with this expenditure which you are incurring in the course of evaluating whether a mine should be dug up or not? For this specific expenditure, there's a separate accounting standard called as Ind AS. Break we will usually stop at around between 8:45 and 9. So that is a typical time where we stop for a break. So bear with me for a little more time and then we can stop. So over here, exploratory and evaluatory assets linked to mining operations will get covered over here under Ind AS 106. This is something which is not important. So in fact, the standard is not even there in your syllabus because this standard has a lot of technical nuances like a lot of seismic topography studies etc. जो एक CA student को इतना नहीं जमता है तो institute ने पहले डाला था इसको. This was earlier there and then Ind AS 106 was removed. But from an academic perspective, you need to know that if there are certain expenses that you are incurring for the purpose of mining operations, they are not covered by Ind AS 16 because though mine is a tangible asset which is held for use with a life of more than 12 months, certain expenses like evaluatory expenses which are linked to mining operations, there's a separate accounting standard. I'll just repeat, there are certain expenses like exploratory expenses, like just if I give you an example, in intangible assets, in your inter-CA, have you studied about research and development? To find an intangible asset, you need to do a lot of expenses which are in the nature of research expenses, a lot of expenses which are in the nature of development expenses. So separate treatment is given under AS 26 for research and development expenses. In a similar way, for digging up a mine, before you dig up a mine, you might have to do a lot of exploration of various areas, a lot of evaluation on whether a mine has to be dug up over here or not, before you decide to dig up a mine. So what do you do with this exploratory and evaluatory expenses? That is covered under a separate accounting standard. Am I clear with this? So like research and development was covered under AS 26. Exploratory evaluatory is not covered under Ind AS 16. There is a separate accounting standard which is still for the purpose of mining operations. Okay. And then the last part, which I would rate is the important part, which is biological assets except for bearer plants, which are covered under Ind AS 41. So what do you mean by biological assets? Biological assets would mean living assets. Living assets. Can you, yes, mine is PP, property, plant and equipment, but just the mining, the expense which is behind the evaluation, exploration is covered under a separate accounting standard. Like a patent that you purchase is an intangible asset, but patent which you are researching, developing is under research and development. Okay. Now, biological assets. What do you mean by biological assets? These are living assets. Can you give me some examples of biological assets? Can you give me some examples of biology? Very nice. Cows, livestock, plants, cattle, very nice. All of these are biological assets. Excellent. Apan sakshat, we ourselves, humans, human resources, are they also biological assets? Yes, I mean almost everyone is mentioning animals and plants. अपन अपने आप को भूल चुके. No, अपन बोल रहे अपन biological नहीं है. No, we are very much biological. However, human resources typically are not assets. Why? Because you cannot control a human being. For something to be for something to be PP, biological asset under Ind AS 41, it has to be asset in the first place. Human resources cannot be controlled. So you cannot, जैसे articleship में हमारा हालत खराब है, but it is not that someone can tie you and tie you to a tree, right? You cannot be owned, controlled. So human resources cannot be owned, and since they cannot be owned or controlled, in general, human resources cannot be shown as assets. If they are not assets in the first place, to classify it as PP or Ind AS 41, intangible does not come, because वो asset के definition में ही नहीं बैठेगा. Are we clear with this? Very nice. So there is no control, and because there is no control, under human resources, you will not have a separate heading for the purpose of human resources. They will not be agriculture assets. They will not be PP. They will not be intangible assets in general. So what we are looking over here is biological assets, which, as you guys have rightly pointed out, can be covered as living animals or living plants. So when we are looking at living plants, or you are looking at living animals, let us say these are used for the purpose of agricultural purposes, living animals. Okay. Now, you said cow, right? Most of you said cattle and cow are biological assets, which is right. When we look at a cattle or when we look at a cow, is it tangible? The answer is yes. Is it held for use? The answer is yes. Is the life more than 12 months? The answer is yes. And hence a cow or a cattle will by default go under Ind AS 16. However, there are special provisions which will apply to a cow. And as a result, we want to cover it under a separate accounting standard. There's a separate accounting standard called as Ind AS 41. If you see your index, under Ind AS 41, there is a separate standard called as agriculture, which will cover a lot of biological assets. So over here, when we look at living plants, which are, let us say, used for the purpose of agricultural activities, there are two. sub-classifications which we will try to study over here. First, there is something called as bearer plants. We will study what they mean. Have you heard about this term before, bearer plants? And then other than. Bearer plants. Okay, what do you mean by bearer plants? Bearer plants are plants which bear agricultural produce and they are not agricultural produce themselves. For example, you look at a coconut tree. The idea of growing a coconut tree is because of the coconut that it bears. So the coconut tree is a bearer plant. It bears agricultural produce, that is a coconut, and it is not the agricultural produce itself. Another example of this can be an apple tree or a mango tree. Most of these fruit plantations, they bear fruits. They not produce themselves. Sir, so every tree does that only? Well, not necessarily. If you look at, for example, a bamboo plantation or a sugarcane plantation, the bamboo tree itself is a produce. A timber wood or a teak wood plantation, the teak wood, the tree itself is a produce. You will chop that down and take the bamboo, take the sugarcane, take the teak wood. So these trees themselves are the agricultural produce. So you guys tell me, if I look at a bamboo tree, is it a bearer plant? Let's say B for bearer, NB for non-bearer. Is a bamboo tree a bearer plant or a non-bearer plant? B for bearer, NB for non-bearer. Very nice. A bamboo tree is not a bearer plant. Why? Because it does not bear any produce. In fact, it is a produce itself. On the other hand, when I look at the coconut tree, what do you guys think? I'm not putting a poll for this, but what do you guys think? If I look at a coconut tree, is it a bearer plant? Well, yes, because it bears agricultural produce. So how do you define bearer plants? Well, there are three criteria, out of which one is just a clarificatory one. First, a bearer plant has to bear agricultural produce and it should not be produce itself. Second, it has to have a life of more than 12 months. So when you look at wheat, W-H-E-A-T, wheat plantations, does the wheat tree, or it's not a tree, but does a wheat plant bear the grain of wheat? Well, yes. So strictly speaking, the wheat plantation should also be treated as a bearer plant. Well, yes. However, bearer plants, remember, are going to be covered under Ind AS 16, property, plant and equipment, and for property, plant and equipment, the necessary condition is that the life has to be more than 12 months. Now, अपन थोड़ा खेती बाड़ी का knowledge अगर अपना रखे, तो when you look at agriculture, there are seasons like the Kharif season, Rabi season, etc. What happens is you grow wheat trees, wheat plants, harvest them, and then once the season is over, you plant new trees. You will see that sometimes the fields are lush green, then the entire fields are clear off and new seeds are planted. So over here, when you're looking at plantations, these plantations do not have a life of more than 12 months. These are called as annual crops. If there are annual crops, you don't do the same with a coconut tree or a mango tree or an apple tree. You don't chop off the entire tree and plant a new tree. You just remove the fruits and the tree remains as it is. So the tree is not the produce. However, over here, you will remove the grains of wheat, but then you will remove the tree as well. So the second condition for a bearer plant is that it has to have a life of more than 12 months. Are we clear with this? So if it is a bearer plant, then a bearer plant will continue to be applied under Ind AS 16, property, plant and equipment. We will study the reasons later once you do the chapter on agriculture as well. But remember, a bearer plant is covered under Ind AS 41. Again, if you have some knowledge, of these cash crops like tea, coffee, rubber, etc. What happens when you look at these beautiful tea plantations, let's say in Assam, let's say in Kerala. When you look at these tea plantations, what do? They pluck the tea leaves. They don't chop off the entire tree. It does not have fruits, but the leaves, the tea leaves are the produce. They trim the plant, but they don't uproot it. So what do you guys think? Think and tell me. A tea plantation. What do you guys think? Is it a bearer plantation or it is a non-bearer? A tea plantation. Is it a bearer plant? Very nice. A tea plant is also treated to be a bearer plant. Why is it treated to be a bearer plant? Because it bears agricultural produce, that is the tea leaves. Again, it has a life of more than 12 months. And as a result, it is treated as a bearer plant. So if you go to balance sheets of companies like Tata Consumer or Tata Tea over here, you will see bearer plants. These tea plantations that Tata has in, let us say, Kerala are treated as bearer plants covered under Ind AS 16 property, plant and equipment. However, if you look at other than bearer plants, if you look at companies like Renuka Sugar, etc., who probably have sugarcane plantations, for these sugarcane plantations, you will uproot the sugarcane entirely and use it for the purpose of manufacturing sugar. You will see that these are not bearer plants, for example. So if it is not a bearer plant, it will be covered under Ind AS 41, which is the standard on agriculture, typically assuming they're used for the purpose of agriculture. We will study what agriculture is at a later date. Are we clear with this? Now, when we look at animals, there is no segregation between bearer and non-bearer animals. So basically, all living animals which are used for agricultural purposes, we will understand what an agricultural purpose is. But for the timing, all living animals which are used for the purpose of agriculture will be covered under Ind AS 41. Always. So there is no bearer / non-bearer concept in animals as per the standard. So over here, if you look at this chart, biological assets are living assets. Living plants which are bearer plants will go under Ind AS 16. Other than bearer plants will go under Ind AS 41. Living animals, Ind AS 41, all animals. So over here we are discussing this. These are biological assets which are for agricultural purposes. You can add this. These are, we will come back to that in any case once we do the standard on agriculture. We'll come back over here. Biological assets which are used for agricultural purposes will be living animals or living plants. Living animals can be someone like, let us say, a sheep, or someone like cow, like what you call as animal husbandry. So for these, there's a separate accounting standard because of the special nature of these items. Like these items reproduce. So if they reproduce, how will the new asset be recorded? At what value should it be recorded, etc. So living animals and living plants which are other than bearer plants are going to be covered under Ind AS 41, which has very different accounting principles, but bearer plants will be under Ind AS 16. So you might get a question in the exam, especially for plants, where the question might just tell you a mango tree which bears the mango fruit and it is held for blah blah blah. It will explain you what the nature of the tree is, and they will ask you to suggest the accounting treatment. You will have to first figure out whether the mango tree is a bearer plant or a non-bearer plant. So do we need knowledge of agriculture? Well, no, not necessarily. The institute will explain you. You are not studying zoology, so the institute will explain you. Like there was an RTP question which had come for someone called as Pinus radiata trees. There was a Pinus radiata tree. The best of zoologists might not be aware of a tree like that in existence. But apne ko to main RTP mein aa gaya. Institute explained. They said an entity has 100 Pinus radiata trees, and I will like you to answer. The entity has 100 Pinus radiata trees which have a life of 30 years, and after 30 years, these trees will be chopped and the wood will be used for the purpose of making furniture and for building materials. And then they give a lot of things. So what do you guys think? A Pinus radiata tree, I will again repeat, a Pinus radiata tree, institute explained you exactly on whether what is the Pinus radiata tree used. It has a life of 30 years, and after 30 years it will be used for the purpose of building materials and furniture. What do you think? It's a bearer plant or non-bearer plant? Well, that's right. Almost all of you have correctly answered it to be a non-bearer plant. No, I can see it should be a non-bearer plant because the tree over here does not bear any produce. In fact, 30 years later, you will just chop the tree off and use the wood for the purpose of making furniture. So it is not a bearer plant. So you guys tell me, Pinus radiata tree will be covered under which standard? Ind AS 16 or Ind AS 41? Ind AS 16 or 41? Well, that's right. It will be covered under Ind AS 41 because it is not a bearer plant. For animals as well, we will study at a lot of length. So we need to also understand what is agriculture, what is not. So we'll keep that discussion at a later date. But you should have a broad understanding of what is covered, what is not. Yeah? Acha. Bearer plants, we have explained, these are living plants which bear agricultural produce like a coconut tree and is not an agricultural produce itself like a bamboo tree. Second, they are expected to bear produce for more than 12 months. For example, a wheat grain plantation will bear wheat in less than 12 months and will be chopped. Hence, it is not a bearer plant. It does not survive beyond 12 months. And third is an incidental condition you can skip because sometimes what has happened is eventually you will, after 20, 30, 40, 50, 100 years, after receiving fruits of the mangoes, you might sometimes chop off the tree. Now, does that mean that if the mango tree is chopped off, mango tree is not also a bearer plant? No, they say that this is like salvage. Fixed assets also, ultimately furniture you are using, but ultimately you will sell. But when you sell it, it is salvage value. That does not mean furniture को आज से ही हम बता देंगे non-current asset held for sale because furniture will ultimately be sold. अरे, till the time you decide to sell it, you are using the furniture. Till the time you decide to chop off the tree, you are using it for the purpose of the fruits that it bears. And as a result, irrespective of the fact that the tree will ultimately be chopped off, till the time it bears fruit. Remember, a Pinus radiata tree does not bear any fruit. Does not give any fruit over 30 years. Over here, the mango tree is held primarily, the primary objective is the fruits that it bears. So, if there's a remote likelihood of the plant itself being sold as agricultural produce except for scrap or incidental sales, it is just a clarificatory point that someone can argue that ultimately we are going to chop off the mango tree, so mango tree is also the produce, but that is incidental. That is not the main objective for which you are holding the mango tree. The main objective is the mangoes that it bears. Are we clear with this? Yes? Okay. So, sir, what is a bearer plant? What is not a bearer plant? Typically, fruit plantations, cash crops like cotton, tea, coffee, rubber, etc. are all bearer plants. If there are special trees that come in your exam, they will tell you what is the nature of the tree. We don't have to study zoology for that. Are we clear with this? Yes? Okay. So, we will stop for a break now. We will stop for, I think, 10 minutes. So it's 8:48 right now. We will assemble back at 8:58 sharp. So we'll go to the accounting aspects. So take a quick breather and be back by 8:58. Okay? I'll continue this session. Okay. So let us resume back. The break goes a lot more faster than we expect. चालू किया और break खत्म हो जाता है अपना. So let's resume back. So we will now go into the core of Ind AS 16. Till now we have done the absolute basics. What is a PP? Well, something which is tangible, held for the purpose of use, having a life of more than 12 months. What is not covered under PP is non-current assets held for sale because they are covered under separate standard 105. Exploratory and evaluatory assets linked to mining operations covered under Ind AS 106, and living plants, living animals which are linked to agricultural activities which are covered under Ind AS 41, except for bearer plants which get covered under Ind AS 16. Now we go to the accounting. Now, initial accounting, at what value should the fixed asset be initially recorded? Initial recognition. You guys tell me, at what value should the fixed asset be initially recorded? Initial recognition should be at what? Should it be at cost? Should it be at fair value? Should it be at net realizable value? What should it be? Well, everyone is in the same direction over here. The initial recognition, the day when you acquire the fixed asset, it has to be initially recognized at cost. So over here, how do you determine the cost? Well, it depends on whether the asset that you are considering is actually purchased or the asset is constructed. So how do you determine cost for a purchased asset? So the cost for a purchased asset will include its purchase price. So for example, if I am buying an asset, the cost will include obviously its purchase price. So let us say if I'm buying a phone, a mobile phone, let us say an iPhone, let us say, the cost will include the purchase price. Or let us say I'm buying a car, let us say the cost will include the purchase price of the car. But what about taxes? Should you include the taxes as well? You are importing a car, you are paying import duty for that. Should that be included as a part of cost? Well, it depends. It depends on whether these taxes are creditable / refundable. If you can claim a credit for these taxes, or you can claim a duty drawback or a refund for these taxes, they are not really a cost. And hence, for creditable taxes, you will not include them as a part of cost, but for non-creditable taxes, you will include them as a part of your cost. For example, if you were to buy a mobile phone for 100 rupees, on which there's an 18 rupee GST, the total cost comes to 118 rupees. For you, you don't see anything, you just look at the total item in your bill and that is your cost. However, if I'm a businessman with a GST number who can claim credit of this 18, I would say that, okay, I'm paying 118 right now, but for 18 I can claim a credit and hence my real cost is 100 rupees only. Am I absolutely clear? Are you clear with the concept of basic concept of credit? Well, yes. And as a result, for creditable taxes, they will not be a part of your cost. Sir, but I'm paying 118. Okay, your journal entry will be mobile asset account debit 100, GST asset or GST input credit asset account debit 18 to bank 118. And when you have to pay your output GST of let us say 20 rupees, you will claim 18 as a credit and 2 rupees additional you will pay. So over here, you will have to look at the purchase price. First, you will look at the purchase price. To the purchase price, you will add the non-creditable taxes. Creditable taxes will not be added. Sir, but we are giving group 1 only. We don't know group 2 indirect taxes. We don't know what is creditable or not. Well, the question will generally guide you. And if it does not, the general assumption is GST, unless given otherwise, is creditable. Other taxes are non-creditable. So you might have import duty, you might have registration charges or taxes, local taxes and cess. All of these are assumed to be non-creditable unless the question tells you otherwise. GST can be assumed to be creditable unless the question tells you otherwise. Are we clear with this? If the tax is refunded, so there is in customs, there is a concept of duty drawback, where if certain conditions are specified, you get a refund of the import duty that you have paid. If it is a refundable tax as well, even that. So creditable generally includes the words refundable as well. So when you say non-creditable taxes, it means non-creditable / non-refundable taxes. So over here, you will take the purchase price. To that, you will add the non-creditable or the non-refundable taxes. If there is refundable or creditable, that will not be added as a part of cost. GST is assumed to be creditable. Other taxes are assumed to be non-creditable unless the question tells you otherwise. So your total cost is 118. So let us say you are buying an asset and you are paying 118. Let us say 18 is non-creditable, 100 is the purchase price of the asset. What should you do with other expenses? Like you are buying an air conditioner. If you are buying an air conditioner, you are paying 100 for the AC. You are paying 18 rupees for the purpose of taxes for which you can't claim a credit. 118 is your cost. But is the AC ready for use? Well, no. The AC has to be installed, and typically if you see there is typically a 1500 rupee installation charge. Let us say for simplicity over here, there's a 20 rupee installation charge or a 15 rupee installation charge over here. Should that installation cost be added to the cost of the asset? Should that installation cost be added to the cost of the asset? Well, yes, because all the expenses that are to be incurred to get the asset in the ready to use condition, that is a condition as desired by the management, to get the asset in the condition and location as desired by the management, should be added to the cost. So for example, if you're buying an AC from, or if you're buying a cooling equipment from Germany, all the costs that are incurred to get the cooling equipment in the location and condition as desired, so will be added. So all your transit cost, loading unloading charges, freight charges, installation charges, without you incurring those charges, packing charges, insurance on transit, without you incurring all of those costs, the asset will not come to the location and condition as desired by the management. So all the expenses which are incurred to get the asset in the ready to use condition, that is in a condition that is desired by the management, are called as directly attributable expenses, and these directly attributable expenses should also be added to the cost. Are we clear with this? So you will add the purchase price. To the purchase price, you will add the non-creditable taxes. You will add the directly attributable expenses. Now, there can be a lot of directly attributable expenses, and hence the institute has given certain clarificatory notes. Again, there were certain discounts. You have been taught in general that what should you do with discounts? Well, if it's a trade discount, you usually reduce it from the price. If it's a cash discount, you directly take it to the P&L. That is a generally accepted norm. So what do you mean by a cash discount? A cash discount is a discount which is linked to early payment. On the other hand, what do you mean by trade discount? Trade discount is a discount which is other than cash discount. So if it is a discount which is other than cash discount, which may be linked to the quantity of goods that you purchase, which may be linked to your negotiating skills, which may be linked to the relations that you have with the supplier, all of these are linked to the trade, and hence these are trade discounts, and trade discounts will be subtracted from the cost of the asset. So purchase price plus non-refundable, non-creditable taxes, plus the directly attributable expenses minus trade discount, if any, that should ideally give you the cost of the asset that you are purchasing. There are a few other things, but for the timing, that should ideally give you the cost of the asset that you are purchasing. But is it possible that you can construct the asset instead of purchasing? Is it possible that you can construct the asset? Well, yes. Apple is in the process of constructing one of the most stunning headquarter buildings that is there. So once they are constructing, they are constructing on their own. So if you are constructing an asset on your own, will you have a purchase price? No. But instead of that, you will probably have a cost sheet. So in the cost sheet, what all will be a part of your cost? You guys tell me. What all should be a part of cost? Should direct material be a part of cost? Well, yes, material that is going in the construction like bricks, cement, etc. Yes. Should the direct labor be a part of cost? Well, yes. Labor which is helping you in the construction should be a part of cost. Any other direct expenses should also be a part of cost. But the problem arises with overheads. Should overheads be a part of cost? Well, there are three types of overheads. There is production overheads, administrative overheads, selling and distribution overheads. Typically, production overheads are considered to be directly attributable in producing or constructing the asset, and hence production overheads, whether fixed or variable, will be added to the cost, whereas administrative and selling and distribution overheads are considered to be not directly attributable to the construction, and as a result are usually not added to the cost. So instead of the purchase price, you will have the construction cost, and this is a construction cost which comprises of direct material, direct labor, direct expenses, and the manufacturing overheads. Are we clear with this? So we'll have direct material, direct labor, production overheads, whether fixed or variable. All of this should be a part of the cost of the asset. Apart from this, any other directly attributable expense over here as well. Usually in the labor, overheads, material directly attributable expenses will be included, but if they are not, any other directly attributable expense will also be added to the cost of the asset. What about borrowing cost? You guys tell me, think and tell me, should borrowing cost be added to the cost of the asset? Let us say you are buying a house. You don't have enough money. Let us say a house in Bombay costs you 300 rupees, 300 lakhs. You don't have that kind of money. So you take a loan to buy a house. So this is a 10-year loan with a 10% rate of interest. Hypothetically, let us say for the entire 300 you are taking a loan, and hence the interest in the first year is 30 lakhs. Should this 30 lakhs be added to the cost of the house? Should this 30 lakhs be added to the cost of the house? What do you guys think? No. Most of you are answering no. Acha, let us say this is a ready to move house. 30 lakh should not be added. Okay. Let us say this is an under construction property. You have put your money in an under construction property. The property is being constructed. It will take around 3 years for the property to get constructed. Your loan is for 10 years, but it will take 3 years for the property to get constructed. What do you guys think? Will this 30 be added to the cost? Very nice. I think most of you are aware. The answer over here is not as clear as the other items. For the other items, purchase price always added, direct material always added. However, for borrowing cost, it is added only in special circumstances, like in inter-CA you had AS 16, in finals you have Ind AS 23, which goes with borrowing cost. What does the standard say? Borrowing cost can be added only to qualifying assets, that is assets which take a substantial period to be ready for their intended use. These assets are called as qualifying assets, and borrowing cost which is attributable to a qualifying asset can be added till the time the asset becomes ready for use. As someone rightly said, till the time occupancy certificate or OC is received, the asset is not ready for their intended use, and as a result, any borrowing cost that you incur during the construction period, let us say construction period is 3 years, 30 rupees interest in the first year, 30 rupees interest in the second year, 30 rupees interest in the third year, all of these interests will be added because it is a qualifying asset taking a substantially long period to be ready for its intended use. Then the borrowing cost during that period will be added to the cost of the asset. However, if it is a ready to move asset, you are buying it from another seller, then the borrowing cost which is attributable to this ready to move asset, well, the asset is ready for use. It does not take a substantially long period of time to be ready for its intended use. It is already ready for use. In which case, the borrowing cost will not be added. It will be taken to the P&L directly. Are we clear with this? Yes, okay. So over here, usually purchased assets are ready for use, but again, I mean, if an asset is purchased and you need to do certain changes to make it ready for use, and if the changes are taking, let us say, more than 12 months, then even that can be qualifying. But typically purchased assets are ready for use, and assets that are under construction, if they take a substantially long period of time to be ready for use, they will be treated as qualifying assets. Again, a substantially long period of time has not been defined. We take 12 months as a reference, but the standard does not mention 12 months. So there will be certain questions which might tell you that the asset takes 8 months and it is a qualifying asset. We will not say it's a printing mistake. अपन बोलेंगे नहीं ये तो printing mistake है. अरे नहीं है यार printing mistake. The law does not say that 12 months has to be considered as the threshold for qualifying asset. No. If the management believes that 6 months is a threshold for qualifying asset, then even 6 months can work. It is on the intention of the management. Are we clear with this? अच्छा, so over here to this you will add the borrowing cost, but यहाँ पे हमने bracket में लिखा हुआ है if it is a qualifying asset. If it is not a qualifying asset, borrowing cost will not be added. Like if it's a ready to move house, 300 पे house देखेगा, any future interest will go to the P&L account. If it's an under construction house, you will add interest till the time the house is ready for use into the cost of the asset. Are we clear with this? Any problems? Can we proceed further? Yes? Okay. Now, there are two specific points which will need some time and we will discuss them at length, especially the second point. First, we have written a note 1 over here. This note 1 pertains to a guidance which is given under Ind AS 16 for the purpose of directly attributable expenses. So you cannot cover everything. However, you can give guidance for certain items. So the standard says that there are certain items which are not treated as directly attributable. There are certain items which the standard specifically tells you not to be treating as directly attributable, and if they are not directly attributable, what should be the treatment? Well, these expenses should therefore be taken to the P&L and not capitalized. These expenses will be taken to the P&L and not capitalized. Sir, what do you mean by the words capitalized? That means they will not be added to the cost of the asset. They will be taken to the P&L directly. Acha, first is inauguration expenses. Remember, most of these are clarificatory points, because otherwise there could be a gray area. What do you mean by inauguration expenses? Let us say you are constructing a property. You are constructing a building for your own use, headquarters of your company. You are constructing a building for your own use. The building gets constructed and you, let us say, call Deepika Padukone to inaugurate the building. Now she charges a bomb for coming and cutting the ribbon. अपन बोलते हैं ठीक है यार, इतना अच्छा ऑफिस बना है, हम inaugurate करवाते हैं उनके पास से. Is that inauguration expenses? Is Deepika coming and cutting a ribbon something which is considered to be directly attributable to constructing the building? The answer is no. And as a result, we say that these inauguration expenses will have to go to the P&L account. They cannot be increasing the cost of the building. Yes, the cost of the building should increase if you use high-grade cement, but it cannot increase because Deepika comes and inaugurates your building. We will say, sir, that is obvious. Not always. For example, we are a fairly religious person. अपन बोलते हैं भाई पंडित जी कुछ भी ना बोले हम कुछ भी नहीं करेंगे. So till the time Pandit ji comes at a specified muhurat and does a bhumi pujan, as you call, हम construction का काम ही नहीं चालू करेंगे. So we do an inauguration of the site. We call Pandit ji, we call a lot of people, we do a party for inauguration, and once Pandit ji kind of ऐसा नारियल तोड़ता है, उसके बाद अपन काम चालू करते हैं. We'll say no, पंडित जी ने बोला उसके बाद ही काम चालू होएगा. That does not, it is not directly attributable to the construction. So that is why this is a gray area. Someone can say that without Pandit ji's approval, our asset would not have been ready. नहीं, वो बराबर है, but that is not directly attributable to the construction. It is kind of an inauguration expense, and inauguration expense has to go to the P&L account. And hence, Institute or Ind AS has directly mentioned this. So now there is no longer a gray area. The standard has told you that you will not take this as directly attributable cost for the purpose of construction, and hence inauguration expenses in any form will go to the profit and loss account. Are we clear with this? Okay. Second is any losses incurred after the asset is ready for use. So any losses after commercial production commences. Sir, what do you mean by this? For example, if I look at the case study of Reliance Jio. Now, Reliance Jio had a big optical fiber network, all of these telecom towers. It entered into the market and then it gave you connections free of cost for a good 1 or 2 years. Do you think that would be expensive? Yes. Its network was being used. However, they did not charge you anything because they wanted more and more people to get a Jio connection. Now that it is done, they are charging you money. So for the 2 years when Reliance Jio operated at a loss, the question is, can that loss of the 2 years be added to the telecom towers, to the optical fiber network of Reliance Jio? What do you guys think? Should that loss be added? The argument over here can be that this loss that you incurred in the first 2 years helped you get a record number of consumers, and now you are reaping the benefits out of it. So should the loss get added? The answer is no. The loss cannot be added because this was incurred after the asset was ready for use. The standard does not say that you keep on adding expenses till the time you make a profit. No, the standard says you keep on adding expenses till the time the asset is ready for use. The moment it is ready for use, if you still use it and incur a loss, that does not mean you add the cost of the asset, add it to the cost of the asset. The standard clarifies and puts to rest that argument, and it says no, losses which are incurred after commercial production has started cannot be added to the cost of the asset. Are we clear with this? Okay. Next, you have again a clarificatory point which mentions training expenses. Training expenses where you are training, let us say, your employees to use an asset or to make them comfortable with a set of customers. For example, you were keeping books in physical form. Now you decided to digitize your record keeping and you got, let us say, 10 computers, 10 laptops, every laptop costing 30,000 rupees. You got 10 laptops costing 3 lakh rupees. Now the problem is your employees don't know how to use a laptop, and hence you took a course from Aptech or NIIT and you trained your employees on using the computer, and now they can use the computer. The question is that the 30,000 for the laptop and there was 5,000 which was charged by NIIT. Can you say that 35,000 is the cost of your laptop? Well, the laptop was ready for use. Your employees did not know how to use it. That does not make the laptop more costly. And as a result, the standard says training expenses have to go to the profit and loss account and cannot be added to the cost of the asset over here. Are we clear with this? So training expenses will be taken to the P&L account and they will not be added to the cost of the asset. Now comes a fairly interesting and a slightly controversial point as well. This is pertaining to relocation or retraining expenses. Relocation. Now, when we look at relocation expenses, why would you do a relocation? Now that is secondary. What do you mean by relocation? Listen to this carefully. This is slightly controversial and debatable point as well. A relocation would arise only after the asset is in the location or condition as desired. So for example, I'm operating from my classroom here, let us say in Mumbai, and now I have installed an AC. So over here, the purchase price of the AC, the non-refundable taxes, the installation charges, all of these will be added to the cost of the AC. Perfect, no problem in that. The AC is in the location and condition as desired by the management. However, now I take my AC on a Bharat Darshan. Everywhere I go, I take my AC and I fit my AC and I use that. So I'm relocating the AC for whatever purpose. Now, does that mean I keep on adding the cost of transporting and reinstalling the AC to the cost of the air conditioner? The AC was 30,000 rupees. I spent 2,000 rupees on installing in Mumbai. AC is 32,000. After completing one batch, I take that AC for whatever reasons. It's a lucky AC for me. I take that AC with me to, let us say, Chennai. Then I take that AC, let us say, to Delhi. Does that mean I keep on adding to the AC the cost of relocating the AC? No, you should not be adding, because the AC is already in the location and condition as desired by the management. So since the AC is already in the location and condition as desired by management, any subsequent expenses cannot be added to the initial cost of the asset. It is then subsequent expenditure for which there is a separate guidance. Relocation expense, the word relocation means it is already in the location and condition as desired by the management. If you are subsequently relocating it, it is subsequent expenditure, and usually subsequent expenditure goes to the P&L. You have not yet studied this, but under inter-CA, you might have studied that your subsequent expenses, that is expenses after the asset is ready for use, can be added only if it increases the life or efficiency of the asset beyond what is originally assessed. So hypothetically, if this relocation increases the life or increases the efficiency of the air conditioner beyond what was originally assessed, in that circumstances, you can consider those relocation expenses as a part of subsequent expenses. But then by default, under initial cost, you cannot add. You cannot say, okay, now I'm again installing the AC as a part of initial cost at the relocation expense. No, you cannot. Does that make sense? Doesn't it increase the value of the AC? I don't know how transporting the AC from Mumbai to Chennai, that typically does not increase the value of the AC by any means. But if you can prove that it increases the efficiency or the life beyond what was originally assessed, then under subsequent expenditure you can capitalize, but initial cost you cannot say. By default you cannot capitalize it. Are we clear with this? Yes, okay. So apart from this, the general understanding is that administrative and selling expenses should not be added. Usually admin and selling are not considered to be directly attributable to construction. For example, you are constructing a plant and there is a general accountant or your company's auditor who is auditing everything, including the functioning of your plant. We cannot say that the part of audit expenses should also be added to the cost of the plant. Typically, these admin and selling expenses are not directly attributable to getting the asset in the ready-to-use condition, and hence they will usually not be added to the cost of the asset. Are we clear with this? Sir, if two AC is installed in the classroom and management decides to remove one AC and install it in another classroom, again, if the two ACs were required for the classroom, initially. The ACs are now in the location and condition as desired by the management. Now let us say I have less students, so I remove one of the AC, take it to the other classroom. That does not by default increase the efficiency or life of the AC beyond what was originally assessed. And as a result, even under subsequent expenses, you should not be adding it. When will you add it? Probably you installed this at a location, जैसे if you are a beach facing house, तो वहाँ पे because of the salt there is a lot of salinity. एंड उसके वजह से आपके एसी के कंप्रेसर सॉल्ट वगैरह से खराब हो जाते हैं. नाउ समवन कम्स एंड एडवाइजेस कि आप एक काम करो, आप एक हाइपोथेटिकली आप एक ऐसा ड्राई एरिया बनाओ, उसके अंदर यू पुट द कंप्रेसर, दैट विल इंक्रीज द लाइफ. दैट काइंड ऑफ रिलोकेशन कैन increase the efficiency or life of the AC beyond what is originally assessed, in which case you can capitalize under subsequent expenses if it increases the life or efficiency. So it's a subjective matter. If it does not increase the life or efficiency, that too what is beyond originally assessed, you cannot capitalize it. See, something which is spare was capable of generating benefits. You did not generate benefits, that does. So if an asset is, let us say, kept idle, that does not mean उसके बाद जो भी आप खर्चा करो, keep on adding to the cost of the asset. There's a difference between ready to use and put to use. The moment it is ready for use, you don't use it up to the optimum capacity is your problem. That does not mean that the asset, इसके लिए अपन बोलते हैं the efficiency should increase beyond what is originally assessed. So when you buy a car, they say that the mileage is, let us say, 15 kilometers per liter. You use it in, earlier you were using it in a city, तो आपको 15 के आपको 8 मिल रहा है. I'm just giving you a hypothetical example so आपको समझ में आए. Let us say you are using a car in a city. The car has an efficiency of 15 kilometers per liter. आप सिटी में चला रहे हो, इतने ट्रैफिक में चला रहे हो, आपको 15 के आपको 7 kilometers per liter भी नहीं मिल रहा. You decide कि बस बहुत हुआ. I want to move from the city to, let us say, a remote area. And in remote area, you don't have traffic, and hence the car is now giving you 15 kilometers per liter. आपको समझ में आ रहा है? Now you guys tell me, is that you have relocated from Mumbai to, let us say, Ladakh, for example? Does that mean you have increased the efficiency of the car? You guys tell me. Have you increased the efficiency of the car beyond what was originally assessed? No. The car was capable of giving you 15 earlier as well. You have not done anything to increase it beyond what was originally assessed. The car was capable of giving you 15. You were using it at a place which was not giving. However, if you put a CNG engine inside, CNG engine, a CNG under compressed natural gas, the car can give you, let us say, 50 or 60 kilometers for the same amount of fuel or gas. That is an expenditure which increases the efficiency beyond what was originally assessed. Are we getting it? So merely because the asset was spare or the asset was used in an environment like a city, and you are shifting it, does not make it more efficient than what was originally assessed. Okay. So relocation by default cannot increase the value of the asset always. If it does, based on the circumstances, and again it is impossible to list down all the circumstances, but as a matter of fact, if it increases the life or efficiency beyond its originally assessed capability, that is when you can capitalize. Otherwise you cannot. But in general, at the time of initial recognition, you cannot say that merely because I am relocating that increase. Relocation means it is expense after the asset is originally in the location and condition. If it was not in the location and condition as desired, then there's no question of relocation. The expenses are incurred to get the asset in the location and condition as desired. Are we clear with this? Yes. Okay. There's another query as well, that if it's a self-finance asset and interest on qualifying asset would be different. Doesn't it affect comparability? It has to affect. In fact, forget a qualifying asset or not. Even if there is no qualifying asset, if a company is fully equity financed, then there will be no finance cost. You don't recognize cost of equity in the P&L. Forget qualifying asset. If a company has 100% equity, it will have zero finance cost, but it still has capital. If it has borrowings, then there will be finance cost. Profit will be lower. Well, because there is borrowing. Profit is lower. Let us say एक company है जिसमें 100 crore का capital है, एक company जिसमें 100 crore का debt है, zero capital है, hypothetically. You will have a company with 100 crores of debt posting a lower profit because of finance cost. finance cost hai, you cannot recognize cost of equity in the books of accounts. So if I am incurring a finance cost, it can go to the P&L, and if that finance cost is for an asset, it will go towards an asset as well. You cannot capitalize cost of equity, you cannot even expense cost of equity. So the treatment disparity is going to remain at both places. The only way you can remove it is bringing cost of equity, whether in the P&L or in the cost of asset, which the standards don't permit because it is a notional cost. It is not readily and correctly determinable, and hence cost of equity does not enter into your P&L or into the cost of the asset. Okay, so these are the general understandings for a directly attributable expense. Any other questions or doubts over here? Can we proceed? Okay, these are directly attributable expenses. There can also be directly attributable incomes. What do you mean by incomes? Well, these are incomes during construction phase. So if there are certain incomes which are earned during construction phase, then what do you do with these incomes? Well, the treatment is same. If these incomes are directly attributable to a cost of construction, if these incomes are directly attributable to a cost of construction, then you will reduce this from the cost of construction, because incomes will have a credit balance. You will not add, obviously it is income, so you will reduce this. However, if it is not directly attributable to a construction cost, then you will take it to the P&L account. Sir, can you explain with some examples? Okay, so over here, let us say you are doing a redevelopment project. So you are constructing your building, but over there is already a building. So you incur certain demolition cost. That demolition cost is directly attributable to constructing your asset. Unless you demolish, you cannot construct. So demolition cost is a cost. It is directly attributable. But once you demolish, you have certain debris. Let us say debris are the remnants of what remains. Let us say you can sell those debris. There is a market. So let us say you incur a demolition cost which is directly attributable of 50 crores, and there is sale of debris. On the sale of debris, you can get 10 crores. What do you guys think? Should that 10 crores be directly taken to the P&L, or should that 10 crores, option A, you directly take it to the P&L, option B, you reduce it from the cost of construction? What do you guys think? Well, we will reduce it from the cost of construction, because this 10 crores is directly attributable to a cost of construction. Like demolition was directly attributable to getting the asset in the ready to use, and this is an income which is generated directly from a cost of construction. Are we clear with this? That's perfect. Perfect. You will reduce it from cost, bang on. Another example over here would be, let us say, if you watch a lot of Bollywood or Tollywood movies, you will see कि कितनी बार जैसे a villain जो होता है उसका अड्डा, his base is almost always an under construction building. उधर लास्ट के जो फाइटिंग के सीन होते हैं, कोई किडनैप होकर रुको तो अंडर कंस्ट्रक्शन बिल्डिंग के अंदर ही पड़े हुए रहते हैं उन लोग. सो ओवर हियर लेट अस से आई एम रोहित शेट्टी हु इज अ डायरेक्टर एंड आई वांट a plot for a scene. Now I'm just traveling in my car and I see a building in a very dilapidated condition in a slightly bad environment. I say, this is a perfect site for shooting my final climax. I go and approach the site manager and I say, I want this site for a 1 month period, and for that 1 month period when I'm using your site, I'll give you, let us say, 10 lakhs or 10 crores, whatever it is, because I'm using your site. The site manager agrees, and as a result, my property is under construction. However, I'm receiving 10 lakhs during the construction period. Is that 10 lakhs which is earned by renting out the place for the movie set directly attributable to any cost of construction? Is that 10 lakhs directly attributable? Let's say rent, income. Is that directly attributable to a cost of construction? No, it is. Is it to be reduced from the cost, or should it be taken to the P&L? What do you guys think? Well, this 10 income should be taken to the profit and loss account. नहीं ऐसा नहीं, it is less than 12 months, so not PP. वैसा तो अपने discuss ही नहीं किया. It is the building construction is taking 4 years. Mr. Rohit Shetty is just using it for 1 month, or let's say 1 year or 2 years. उसमें PP is not based on how much time Mr. Rohit Shetty takes for the purpose of his shooting. It takes how much time is ready for the building, right? So you will take it to the P&L account. You will not reduce it from cost because it is not directly attributable to the construction. That's perfect. Again, there's a clarificatory point. Let us say there can be certain testing cost. Remember, a lot of times you will have to test, and these tests are mandatory. So let us say you are building space rockets, or you are building cars or certain assets. Before they are ready for use, you will have to show certain tests that this is safe to fly. For example, let us say you are developing your own aircraft. For example, obviously you can buy these aircraft from Boeing or Airbus, but let us say you are developing your own aircraft. If you are developing your own aircraft, you will have to first test it and show it to the Director General of Civil Aviation that this is fit to fly. So all of these costs that you are incurring to test, should that be added to the cost of the aircraft? Should these costs be added to the cost of the aircraft? Yes. In a similar way, let us say you are constructing let us say an amusement park, let us say Imagica. You have constructed a lot of rides. Obviously these will be the cost of constructing these rides will be a part of the cost of the park. But before you open the park to the public at large, you will also have to do some testing on whether these rides are safe, whether they are working in a monsoon environment or in overheated environments. So you'll have to do these tests, trial runs jo karte, before you can open the park to the public at large. Will this testing cost be a part of the cost of the asset? Yes. So this testing cost, let us say, is a part of the cost of the asset, and you are regulatorily required legally to incur all of these tests. Okay, so let us say you incur this 100 testing costs, which is a part of the cost. I think all of you are clear about that. Now let us say before you make the asset ready for use, you want certain people to take those tests. Sometimes you'll have to pay these people, like during coronavirus, human trials jo ho rahe the, some people were ready to experiment the vaccines on them, for which companies would pay. Sometimes companies don't need to pay, like an amusement park. They can always tell to the nearby village that if you want to enjoy the park before it launches, as a special feature, 1,000 ticket will be available for 100 rupees only. So let us say the nearby people might be happy and they might use that ride, and they might actually pay the company 100 rupees. This is fact based. Should they pay, should they not pay, is a moral discussion which we are not going to enter into right now. But let us say I've incurred a testing cost of 100 rupees, and during those testing, people who have used the products or services have paid me certain income which comes to, let us say, 10 rupees. What do you think? Should that 10 rupees, which is income generated from the products that I've manufactured during the trial run, should that income be taken to the P&L account, or should that be reduced from the testing cost? No. So if the construction is not completed, you have to see that the income that is earned, is it directly attributable to a cost of construction, like sale of debris is directly attributable to demolition, the sale of products directly attributable to testing. So if they're directly attributable, then you reduce it from cost. If they're not directly attributable, you take it to the P&L account. That is right. You will reduce the testing cost, and your net testing cost will be 90, because it is directly attributable to testing. So this testing cost is capitalized, and hence the income that is earned from the testing cost will be taken to the P&L account. Are we clear with this? Is everyone clear? Yes? Okay. So this is the guidance that the institute has given for directly attributable expenses. So when we see note 1 over here, they have mentioned that directly attributable expenses are expenses to bring the asset in the location and condition necessary for it to be capable of operating in a manner as intended by the management, basically ready for use. The following items will not be considered as directly attributable: inauguration expenses, losses or expenses after the asset is ready to use, the cost of staff training for operating in a new environment or a new set of customers, relocation expenses, and administrative and general overheads. Next, incomes from the asset should be taken to the P&L in case they are not directly attributable to the cost incurred to get the asset in the ready to use condition. Like if you have bought a plot, construction has not started, the plot is lying vacant, you give that out for car parking. That is not attributable to constructing the asset, take it to the P&L. However, in case incomes are directly attributable to the construction, they should be deducted from the cost of the asset, like sale of debris in a redevelopment project should be reduced from the cost of the asset. Okay, so we go to the last part for today's class as well, and this is fairly interesting and important as well. Your lecture ends at 10:15, so we will try to cover this part today. So tomorrow we can do the sums. You have various sums over here pertaining to this, and also the special cases linked to the initial recognition. Are things clear? Can we proceed further? Acha. Now this is something which is new. It has two standards covered. Like borrowing cost is a standard which we have yet to do, but we have given a broad glimpse that if it is a borrowing cost which is attributable to a qualifying asset, you can capitalize. If it is not attributable to qualifying asset, take it to the P&L account during the period of construction. In a similar way here, there is another standard at play which is Ind AS 37, which we are yet to do. But then if you do Ind AS 37 first, Ind AS 16 rahega. So at the end of it, you will understand everything properly, but I'll just give you a complete background. Ind AS 37 is very similar to AS 29, provisions and contingencies. Now, please pay attention to this. The next 20-25 minutes are fairly important. Okay, so over here, let us say there is a company which is evaluating, constructing an asset, let us say a mine or some asset, for example, let us say it is covered under Ind AS 16. The construction cost over here, let's say there is a site A, there is a site B. The construction cost in site A is 90 rupees. You can construct this for 90 rupees. Whereas the construction cost in site B is 100 rupees. Initial cost, the efficiency, etc. is all the same. This is a cost that you incur at year 0, immediately, currently. Which of the sites is cheaper? Well, you would say, sir, it's a no-brainer. Site A is cheaper. Perfect. So your entry over here would be, let us say, PP account debit 90 rupees to bank 90 rupees for site A, or your entry will be PP account debit 100 rupees to bank let's say 100 for site B. Now, this is for the initial recognition, okay, for the asset. Let us say site A is located in a populated area, whereas site B is located in a very remote area. It can also be in the middle of the ocean, like oil rigs are sometimes in the middle of the ocean as well. Site B is in a very remote area, site A is in a slightly populated area. Now, if you are digging up a mine, and let us assume it is covered by Ind AS 16, if you are digging up a mine, once you extract all the resources out of the mine, you have nothing left. So as a company, you would say, yaar, abhi chodo, you will leave the site. Now, if someone comes walking, वो तो mine के अंदर गिर जाएगा, they will fall inside them. अपन बोलते गिरने तो अपने को क्या लेना देना? Government says नहीं. That is not possible. If I am allowing you to dig up a mine over here, as a part of your allotment, where you can dig up a mine in a particular site A, there will be a condition which says that you are under an obligation to restore the mine in the condition it was before the mine was dug up. So आपने पूरा खोद के एक बड़ा खड्डा किया, a big hole you have dug up. Now once you use and extract all the resources, you will have to restore the site to the location and in the condition it was prior. Or there can also be other commitments like dismantling or decommissioning commitments. Like for example, if you have watched this short web series on, I think, Hotstar or something, Chernobyl, or forget that, it's if you set up a nuclear plant, let us say you set up a nuclear plant. Now, you can generate that nuclear energy over there, let us say for a period of 40 years, 30 years. After that, you say, abhi chhod do, enough ho gaya humko, abhi hum dusre jagah pe chale. Well, that is radioactive material. You can't keep it as it is. You will have to decommission. That means you will dismantle the materials. You will dig up or you will bury them or dispose them in a manner which is specified. This is a decommissioning or dismantling commitment. When do you have to do this decommissioning or dismantling or site restoration? Do you have to do it initially? No. You have to do it at the end, once the project is over. However, the commitment that you have to dismantle is existing in the contract. It's a legal commitment. Are we clear with this? So over here, you estimate an estimated SRO. I'm saying SRO is site restoration obligation. SRO is site restoration obligation, which is expected to be incurred in year 10. Let us say this is 40 rupees. B is located in a very remote area or in the middle of the ocean. The government does not tell you to restore it. They say that you can leave it as it is as well. You don't have to restore it, dismantle it, kuch nahi. But A, you have to restore or dismantle. That is written in the contract. It is a legal commitment. Okay. At year 0, if I pass the entry PPE account debit to bank, for example, for site A, I will spend 90 rupees. For site B, I will spend 100 rupees. Should I consider the estimated site restoration expense at year 0, at the time of initial recognition of the cost of the asset? Or should I wait for year 10 and then record it at year 10? What do you guys think? Site restoration expense, should I record it at year 0 at the part of initial recognition or at year 10? Okay, so most of you believe that this should be recorded initially at year 0. That is absolutely right. Now, why should it be recorded initially? Because someone can say we will record it at year 10, but year 10 is cash system of accounting. You are going to pay the money in year 10, fully agreed, but we are following accrual. The obligation to dismantle exists from day one. For example, you decide not to use the site for 10 years. अपन बोलते site construct हुआ, 1-2 दिन use किया, we said नहीं यार ये तो पनौती site है, we don't want to use it anymore. Are you under an obligation to dismantle even on the second day? Yes, you can't leave the site as it is. The obligation to dismantle exists. The moment construction is done, you are under an obligation to dismantle. And hence the obligation exists from day one. Yes, you will spend money later. It is like saying in your inter CA, you create a provision for warranty. If you remember, आपने AS29 पढ़ा रहेगा. In that case, you create a provision for warranty. You sell laptop. You are Dell computers. You sell a laptop. You believe that there is a warranty period of 3 years. People will come and you will have to repair over the 3-year period. You don't have to repair immediately. You believe that repairs will happen after 1 or 2 years, but you still create a provision for warranty immediately, because the moment the sale happens, you are under an obligation to repair. If the customer comes to you on the second day and says this is a defective product, you will have to repair. The obligation to repair exists the moment you make the sale, you give the warranty card. It does not exist when you actually repair. That is when you actually spend money. आपको समझ में आ रहा है? Yes? Okay, so over here, the obligation to dismantle exists the moment the construction is done. You will discharge that obligation at the end or whenever you decide. However, the obligation exists, and as a result, you will have to create a provision under Ind AS 37, also similar to AS 29. Provisions and contingencies. You have not spent that amount, but you are under an obligation, and hence the provision exists. So over here, you will have to create a provision, to provision for site restoration has to be created. Now the problem is, yes, you will create it. This is logical. However, every entry has to have two effects. The credit effect, yes, you will create a provision for site restoration at some amount. We will not go into that amount for the time being. You will have to create it at some amount. But then you will have to debit it as well. What will you debit? If a provision for site restoration is credited, something has to be debited. What should be debited? You have two options. You can debit the PPE or you can debit the PNL. What do you guys think? Should you debit the PPE or should you debit the PNL account? If you debit the PPE, the cost of the asset initially will increase. If you debit the PNL, the cost of the asset will remain the same, but your expense in the PNL will increase. Very nice. Most of you, almost all of you are mentioning that the PPE should be debited. Why? Well, because that makes the asset more costly. The real cost of the asset is not 90 rupees. Optically, it might appear that 90 is the cost of the asset, but that is not the cost of the asset. 90 is merely what you've spent right now. For site A, the real cost is much more. If I take this site restoration to the PNL, what will happen is this will appear as 90, this will appear as 100. When I compare two financial statements, I would say, yaar, tumne, if the management decides that let us go to site B, kuch restoration obligation nahi hai, then your PP will appear at 100 rupees. Shareholders will question you. They will say, yaar, 90 rupees mein asset ban raha tha. Why did you do it at 100? Your competitor has taken it at 90. That is wrong. 90 is not the true cost of the asset. The true cost of the asset is much more. It is not 90 rupees. However, it is appearing as 90 because you are just looking at the cost incurred right now. When you are agreeing to construct the asset, you are committing to pay 90 now, which you have paid, but you are also committing to pay 40. Or an estimated amount of 40 after 10 years. This estimate can change, and if it changes, what will happen? We will study that at length. But that estimate can very well change. Are we clear with this? And as a result, you will create a provision for site restoration. At what amount will you create a provision for site restoration? Well, should you create it at 40 rupees or some other number? What do you guys think? The amount of site restoration, we are clear that you have to debit the PPE because that increases the cost of the asset. It makes A more expensive. But now we go to the amount. At what amount should you do it? Should you do it at 40, which is the estimated amount, or some other amount, like the present value of 40? What do you guys think? 40 or the present value of 40? Very nice. It should be at the present value of 40. Why should it be at the present value of 40? Because you are recording the cost of the asset today. Well, 40 rupees spent after 10 years is not equivalent to 40 rupees that is spent today. And as a result, over here, let us say you will estimate a discount rate. For the time being, let us assume it is given. In all questions, it will be given, but let us say over here the discount rate, for example, is 10%, in which case your provision for site restoration will be calculated as 40 rupees, which is to be spent after 10 years. So your present value factor at the rate of 10%. I hope you are aware on how to calculate this. If not, on your calculators, you will take 1 divided by 1.1 equals to, you will do that 10 times. I think this is 0.385 approximately. 0.3855 or 0.386 for the time being. Let us say this is 40 into 0.3855 comes to around 15.42. So 15.42 will be the provision. Why are you showing this as provision? Because you are under an obligation to pay. You have not paid it today, but you are under an obligation, and that increases the cost of the asset. If hypothetically, if someone told you that instead of paying 40 rupees after 10 years, you deposit that money in a bond, or you create a sinking fund, if you are aware, you deposit it. 15.42 deposited today will slowly become 40 after 10 years. And as a result, if I had to spend that money today itself, I don't have to spend 40 today. I can invest 15.42 today, which will slowly grow up to 40 after 10 years. Does this make sense? So if I add 40 together, I will say that the cost of the asset is 90 plus 40, that is 130. Array, 130 you will record as cost today. You don't have to spend 130 today. You have to spend 90 today, that you have done. And if you want, you can put 15.42 somewhere, and that can actually reach up to hypothetically 40 after 10 years. And hence the total value in today's terms has to be 105. 0.42. So your total value is 105.42, and now when I compare it, B does not have any such commitments. Now when I compare it, I see that A is more costly. That will give me the true cost of A. 90 that I spent today and 40 that I am under a commitment to spend. I cannot escape it. After 10 years, which in today's terms is worth 15.42. How can we decide the present value rate in an asset? You will find the discount rate. Ind AS 16 has given you guidance. The discount rate is based on various factors considering the time value, inflation, the risk along with the asset, etc. So it will be given to you because you're doing an accounts paper, you're not doing an estimation exercise. Like fair values are given to you in an accounts paper. In SFM, you estimate that fair value, but in general, the discount rate is to be calculated considering the risk of the asset, considering the inflation, time value into consideration, and all of these factors. Are we clear with this? Okay, so let us say you are now into site A. Now the question arises that how will this be accounted for? Let us say the life of the asset is 10 years. Then what will happen in your PPE account? You will depreciate the PP every year. There will be a depreciation entry, depreciation account debit. Let us say we are following SLM method, 105.42 divided by 10. So let us say depreciation each year will be 10.54 to PP. So basically after 10 years, your PP will become what? You guys tell me. Your PP at the end of year 10 will become what? Well, it has to be becoming nil. The PP after 10 years has to become nil because you cannot sell the PP and generate any salvage value. So your PP has to become nil. It will become nil. 10.54 will go to the P&L in each year, and through that the entire asset will be written off, will be taken to the P&L. Perfect. Without touching your calculators, you guys tell me what should be the provision for site restoration balance. Like PP should be 0. But provision for site restoration at the end of year 10 should ideally be how much? You guys tell me without touching your calculator. Excellent. The provision for site restoration has to be 40 rupees because ultimately you know from day one, assuming your estimates are correct, your estimates might change, and we'll study that in the later sums, but for the time being, to strengthen your concept, you know as a matter of fact you have to pay 40 rupees, and hence your provision like asset should slowly move from 105.42 up to a nil value through depreciation. Your provision should also slowly move from 15.42 all the way to 40 because if you don't do anything, your provision will continue to remain at 15.42. Then after 10 years, suddenly you will have to spend 40 rupees. Your entry will be provision account debit 15.42 to bank 40. There will be a huge expense that comes in the 10th year. But is that expense coming because of the 10th year? No, it is to be recorded over 10 years. You have the benefit of 10 years time. Instead of paying something today, you pay it after 10 years. The hit should not go only in the 10th year, it should go over 10 years. Does that make logical sense? Does that make logical sense? Well, yes. So provision has to be slowly credited because we know that we have to finish the journey from 15.42 and reach up to 40 rupees. So provision has a debit balance or a credit balance? Sir, credit balance. So if I want to increase the provision, I will have to credit it. Okay. So each year I will have to credit the provision for site restoration. How much you will credit it, wo apan dekhenge. But something has to be debited. Now this is where the problem arises. Something has to be debited. What will you debit? Will you debit the P&L account? Naam chhod do. Will you debit the P&L account or will you debit the PPE? Will you debit the PPE or will you debit the P&L? Please tell me. What do you guys think? Okay. So again, there is a mixed verdict, but largely most of the students seem to be tilted towards P&L. Okay. Now let us ask a question. If an asset is ready for use, let us say, and there is borrowing cost, which is still getting incurred. You have taken a 300 rupee loan, the asset was 300 rupees, the asset is ready for use. You are still paying interest on the loan. Where will the interest go? Will you keep on adding the interest to the cost of the asset, or will you take the interest to the P&L account? Forget this. Will you take the interest to the P&L account? The asset is ready for use. It's a 10-year loan. ऐसा नहीं कि हाउसिंग लोन में हाउस रेडी है तो पूरा लोन वापस रीपे कर देना है. नो, इट्स अ 10-year loan. You have to pay interest each year. Do you add it to the cost of the asset, the house, or do you take it to the P&L account? Interest is taken to the P&L. Excellent. Why? Because any expense which is incurred after the asset is ready for use is to be taken to the P&L account. Okay. Over here as well, whatever these expenses are, whatever you call them, are they incurred after the asset is ready for use, or are they incurred before the asset is ready for use? Well, this is incurred over 10 years. This is a cost which arises due to the passage of time. This is a cost which will arise. So what will happen is, over here, let us say, this is just a mathematical thing, something that you would have studied when you do time value of money. For example, when you are at year 0, you are at 15.42. When you are at year 10, you are at 40 rupees. Now, as 1 year passes, you reach year 1. Now, this 40 rupees is how many years away? Is it still 10 years away? No, it is now 9 years away. 1 more year passes, you are at year 2. Now, this same commitment of 40 is how many years away? Now, it is 8 years away. So, as one year passes, 15.42 keeps on coming closer and closer. So, the cost arises as each year passes. Does this make sense? Well, since the cost arises as each year passes, this is a cost which is arising due to passage of time, and hence it has to be recorded in each of the years after the asset is ready for use, and hence it has to go to the P&L. Only those costs which are attributable to items which are to be incurred at the time the asset is, it is directly attributable to getting the asset in the ready to use condition. Obligations arising in order to get the asset in the ready to use condition can be capitalized, and hence this is called as unwinding cost. Unwinding of discount. Sir, ये क्या नाम है? Well, unwinding means क्या हुआ? Quite literally, an expense which was worth 40 rupees was wound up, it was tied up, it was squeezed and made 15 rupees ka expense. Something which was worth 40 was recorded at 15 at year 0. Now slowly it unwinds. Slowly it moves from 15 to 18 to 20 to 22 to 25 to 27. This is called as unwinding. Now, ये अपन बोलते हैं चलो ठीक है, you will see if company's financial statements, you will see unwinding of discount. This is called as unwinding of discount. Now the question is, ये सब तो ठीक है, where should the unwinding of discount go? Well, it will go in the P&L. And just for your knowledge, where in the P&L? In P&L, you have employee benefit expense. Do you think this is an employee benefit expense, sir? No. Is this depreciation? Well, no, sir. Assets get depreciated. We are dealing with provision. The entries, unwinding of discount account debit to provision. Provisions don't get depreciated. Assets get depreciated. Acha. Then is it purchase cost? Is it what is it? Well, this is a cost which is attributable to passage of time. What are other costs which are attributable to passage of time? Interest cost. Where does interest cost go? Well, it goes in the finance cost. Well, this is not strictly speaking interest. This is not interest. However, interest is linked to the passage of time. As time passes, interest cost gets recorded. In a similar way, this is also getting recorded due to the passage of time, and hence it falls within the larger purview of finance cost. You look at a lot of these companies like ONGC, etc. क्या balance sheet उठा के देखो, आपको finance cost के heading में दिखेगा. Unwinding of discount. So over here, you will look at finance cost. ONGC is into oil exploration, and hence they have, if you see their balance sheet, this unwinding of discount. So over here, this will go within the larger heading of finance cost, and over here we have a finance cost worth let us say how much. Are we okay? Are we at least clear with this? Amount अपन reach करते हैं, but are we clear with this? Okay. So what will be the amount? You guys tell me on your own. We have not discussed anything. you have the number scheme in front of you. What should you think should be the amount at which entry should be passed in the first year? You are now in year 1. What should be the amount at which the entry is passed? See, 15.42 was discounted. 40 को आप डिस्काउंट करके लेके आए फ्रॉम प्रेजेंट वैल्यू, फ्रॉम फ्यूचर वैल्यू ऑफ 40 यू केम टू द प्रेजेंट वैल्यू ऑफ 15.42. नाउ यू आर गोइंग फ्रॉम द प्रेजेंट टू फ्यूचर. ये अपन टाइम वैल्यू ऑफ मनी में आ गए. आपने जो एक जमाने में पढ़ा था, आपने बोला क्या टाइम वैल्यू पढ़ा रहे, अभी उसका एप्लीकेशन आ रहा है. सो if you take a number which is going to be incurred in the future, that is 40, to the present, this is 15, that process mathematically is called as discounting. But then when you go from 15, slowly you want to reach to that same 40 number, that process is called as compounding. If discounting happened at 10% and you went from 40 to 15, if you go compounding, it should be done at what rate? It should also be at 10%. And hence we will say that okay, we are compounding, so 15.42 has to reach ultimately to 40, and hence you will have 1.54. Acha, will this 1.54 remain the same? Will this 1.54 remain the same? No. Remember, this is again an act of compounding. So what will happen is year 1, 2, 3, 4, 5, 6, 7. We should have taken a smaller example, but nevertheless, the same example is also there in your shield, so you don't have to write it again. If you want, you can refer the shield as well. This is slightly more detailed. So your opening balance, if I look at the provision, now I'm doing end-to-end workings for your absolute deep understanding. So for provision for site restoration, your opening balance was 15.42. Sir, ये 15.42 कैसे आया? Through that initial recognition entry, PP account debit 105.42 to bank 90 to provision for site restoration 15.42. So you got your opening balance as 15.42. Now the journey from 15.42 to 40 rupees. So over here there will be unwinding. We can call this as finance cost for the time being. This finance cost will be at the rate of 10%. So over here this will be 15.52 into 10%, roughly 1.54, and hence your closing provision is 15.42 plus 1.54, which is 16.96. Are we clear with this? Your closing provision is 16.96. Are you guys clear with this? Please answer yes or no. I need you to have a complete understanding on this concept. Acha sir, can I also calculate this 16.96 using an alternative method? Yes, we don't need to do it, but this is just for your complete conceptual understanding. Once you are at the end of year 1, you guys tell me, how much do you expect to spend? Sir, we expect to spend 40 rupees. After how many years do we expect to spend that 40 rupees? After how many years do you expect to spend that 40 rupees? Please answer. After how many years do you expect to spend that 40 rupees? Very nice. 9 years, not after 10 years. Sir, we were expected to spend after 10 years. Yes, but 1 year has already gone by. And as a result, once you're sitting at the end of the first year, if you do the calculations, you will say, okay, let me measure the provision. I have to spend 40 rupees, but at the end of the 9th year. So you can cross check this and say that, okay, 40 rupees to be spent at the end of the 9th year into the please take your calculators, present value factor at the rate of 10% for the 9th year. Please find this on your calculators. 1 divided by 1.1. Do I see 0.4241 approximately on my calculators? I do 40 into 0.4241 and I will get 16.96 precisely. So what I'm trying to do is, I'm trying to show the provision at the end of each balance sheet at a number which is what an entity expects to spend at the end of year 1. If a balance sheet is as on date, it is not for the period. So on the balance sheet, if I continue to show 15.42, I'm showing the provision wrongly. 15.42 was 40 rupees to be spent after 10 years, but you are now at the end of the first year. So this has to be 40 rupees spent after 9 years, which is 16.96. Are we clear with this? Yes? Okay, we'll just cross check that once more as well. In the next year, what will be the opening balance? Your opening balance will now be 16.96. Your provision is 16.96, which is now coming one more year closer. Compounding. Remember, discounting opposite hota hai compounding. So you will take 16.96 into 10%, and hence this will be 1.69, or roughly, let us say, rounded off 1.70. 16.96 plus 1.70 comes to around 18.66. Now you guys have to tell me. I'm at the end of the second year. I still expect to spend 40 rupees, but after how many years? You guys tell me. I expect to spend 40 rupees, but after how many years? Very nice. Now you are getting it correct. This is after 8 years, and hence if I want to truly show the provision on my balance sheet, the long-term provision on my balance sheet, I'll discount 40 rupees, which is expected to be spent after 8 years, and hence the present value factor will come to 0.4665. If I multiply this for cross-checking, 40 into 0.4665, and there you go, 18.66, precisely the number that we calculated. Are we clear with this? Acha. Now, if I continue to do this, this is 18.66. I'll get 1.87. So to that you add 1.87. I get 20.53. I go to 20.53, 2.05. So I will add and I will get 22.58. अच्छा, अभी अपना नंबर बढ़े जा रहा है. According to you, अपना गाड़ी किधर जा रहा है? Where are we headed? Where is our end destination? 2.26, 24.84. Please answer in the chat box. Where do you think our destiny is over here? Plus 2.48. 27.32. You have 27.32, 2.73. Perfect. Your answers are correct. We are trying to reach 40. Let us see if our calculations are correct. You will reach there. 30.05. This is 3.01. I'm just rounding off. 5 and above you round off. So this is 33.06, and you have 3.31 plus 3.31 and 36.37. You take 36.37, and to this you add, let us say, approximately 3.63 approximately, and you get 40. Mission accomplished. You should have reached 40. So what will happen is, if I look at the journey from year 0 all the way to year 10, if I look at the journey from year 0 to year 10, my entry will be at year 0. Please pay attention to this so that you get a logical closure now. Year 0, my entry will be PPE account debit 105.42, to bank to bank 90 rupees, to provision for site restoration 15.42. Then when you go to the annual entries from year 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So if I look at each of the individual years, what will be the entries? 1, 2, 3, 4, 5, 6, 7, 8, 9 and 10. Approximately, if we kind of pass these entries, over here in each of the years, your entry will be depreciation account debit to PPE, and depreciation will go to the P&L account. So every year 10.54, 10.54, karte, total over 10 years, how much will go to the P&L as depreciation? Yes, we will study that. Changes in estimates, changes in discount rate, we will study what will be the impact. For the time being, we are just getting the basics right. There will be detailed sums on changes in estimates, discount rates, everything. What will be my total depreciation over 10 years? Please tell me. 105.42, perfect. So that will be your entire cost of the asset will slowly be expensed to the profit and loss account. Acha. Apart from that, you will also pass the entry, let's say finance cost, or you can also call it as unwinding, whatever it is, which will go to the P&L as you said, unwinding to provision. At what value will this happen? Well, it will start with 1.54, then go to 1.70, 1.87, 2.05, 2.26, 2.48, 2.73, 3.01, 3.31 and 3.73 approximately, or 3.63 approximately. So if I were to total all of these, what will the total be? So if I take my calculators and total 1.54 plus 1.70 plus 1.87 plus 2.05 plus 2.26 plus 2.48 plus 2.73 plus 3.01 plus 3.31 plus 3.63. Approximately this is 24.58. Perfect. So this is 24.58. So your total finance cost that has gone over the 10 years is 24.58. So let me just put that 24.58 over here. So if I total all of these, now we are just coming to a conceptual point. ये exam में करना ज़रूर नहीं है. We are just closing the loose ends. If I total this is 105.42 plus 24.58. So this is 130, and 130 totally goes to the P&L. A part of the 130 goes through depreciation, a part of the 130 goes through finance cost, and ये 130 basically क्या है? 90 rupees initial cost plus 40 rupees that you pay ultimately. So ultimately आपका P&L में जाता है 130 रुपया ही. What you have spent, 90 rupees you have spent for the asset, and another 40 rupees you have spent for the purpose of dismantling. Ultimately everything goes to the P&L, but some things go in the form of depreciation, some things go in the form of finance cost. Are we getting this? So this is how your entire movement will happen. Achha, at the end of year 10, what will happen after all of these entries are passed? After all of these entries are passed, at the end of year 10, PP becomes 0. But provision will be at 40 rupees and you will spend the money. So your entry will be provision for site restoration account debit. Let us say estimates don't change to bank 40. Estimates can change and we'll see what is to be done. So nothing hits the P&L now and all your accounts are closed. PP becomes 0, provision becomes 0, and what has to go in the P&L over 10 years has already gone into the P&L. Over 10 years. This same example, including the numbers but in a slightly more compressed form, is given in note 2. You can refer that or you can refer the board notes for this. Any problems over here? Otherwise we can wrap up the lecture for today and we can continue the sums in tomorrow's class. Any other issues, doubts, questions? Acha. If not, that should be it. I'll just hang around for some time on the live session as well, or on WhatsApp. If you have any queries, please do let me know. Please do revise whatever has been done. At least we have done the theory. Tomorrow we will be doing the application. So just ensure you spend a few minutes. Today's class was an introduction class, so it will happen much more faster, but spend a few minutes and revise whatever has been done so that we are well placed for tomorrow. Okay? Chalo, have a good day, enjoy, have a good time. Bye-bye, take care.